Here we go. FTSE 100, 79.37 was the close, unchanged. Let's just see if we get the pop that we're anticipating. There we go. We turn green right on cue. We'll see how some of these big mining stocks do over the next few hours. We are building up to the claims data out of the States a little bit later on. But the expectation after a decent run for the miners and the commodity stocks, are we going to see that continuing into today's trade? In terms of where the points are coming through, first thing this morning, ASML, Astra, HSBC all higher this morning. Schneider's looks like it's rising as well. Yeah. Novo, a little bit of softness coming through into Novo, which I think is interesting as well. And the luxury stocks look soft. Ferrari, a little soft this morning. In the red, which appears appropriate.
Do you want to spend a second on Ferrari? Can you explain the downgrade here?
It's had a great run. So this has been one of those kind of stock stories that's had a really good run. This is one of the few companies that has pricing power still left. Yeah. It's like if you think about the Immerse, if you think about Birkin bags, this is the kind of the Birkin bag of the car industry.
Thank you for simplifying that. I didn't know what a Ferrari was.
No. But in terms of
I got you.
That's how you want to position this stock.
Yeah.
So my next question off the back of that is, if it's Ferrari's rolling over, does maybe Immerse roll over as well?
That's actually a fairly good point. Speaking of what's rolling over, let's talk about this commodity sector here, because we were talking about whether it was kind of running out of momentum. And it kind of seems like it is a little bit. If you look at some of the names that are outperforming, you see a similar trade that you've seen the last couple of days, which is rates higher, therefore banks higher. But if you look at the commodity names, Shell is on the back foot today.
Yeah, it is.
BP is on the back foot today. So I think what's interesting is seeing that divergence between the oil names and the banking names, because that's been different from the last two sessions that we've seen this week, despite the fact that rates are a little bit higher, oil's a little bit higher. Something's going on with the big oil story.
So maybe we already had the run, which I think is interesting. But Rio is up this morning. Glencore is up. So the miners are tracking higher.
Yeah.
But you're not getting the same thing in the oil story. There you've got Diageo. Shell is the second. Shell's the biggest points drop now on the FTSE 100.
Yeah.
It's dropping around 2.5 points off the FTSE. So yeah, no, it's a fair point. We are seeing some of that weakness coming in. And on a day when we see NATO celebrating its 75th anniversary, BAE Systems is also a little soft as well.
I think the trade here, to me, on the surface at least, feels that cyclical's on the back foot today. And I'm not super sure what the fundamental reason is around that. Is this just a cautious trade? Is this just a positioning story, as you point out, that maybe the momentum has just run out?
Yep.
Especially when you're seeing a lot of these healthcare stocks outperform. AstraZeneca, GSK, for example, coming out on top, but still in line with the banks. I can't wrap my head around the fact that banks may trade in line almost with healthcare. That to me seems like
banks are kicking out so much cash at the moment. I think that's the trade.
Basically, like a liquidity
it's a return. Well, they've got the argument is they're overcapitalized. This started in February, this argument, and it's really run since then. The banks are overcapitalized. They're going to kick out lots of money. They're going to return money to shareholders. How long does that last? I think is the question.
All those fund buybacks and dividends.
Oh yeah.
Yeah. Buzzwords there. Let's talk a little bit about the LVMH story, though, because I think it's interesting that we're seeing heavyweights pull back at a time that I still don't know what's driving it that either, because do you see the likes of LVMH, et cetera, trade in line with the likes of ASML as this big cap outperformance, or do you see it more become a Chinese consumer story, a European weakness, even a currency story, arguably?
I think there's a strong argument that says that you've got a catch-up trade that I think is in play at the moment. We've been talking about it over the last couple of days. If you want to play catch-up in Europe, what do you have to own? You have to own LVMH, you have to own Immerse, you have to own ASML. So I think it's going to be really interesting to see how that trade oscillates. It's not going to be a straight line, but I think you kind of want to watch it over a few days, maybe a few weeks. Does Europe play catch-up And are those core stocks going to be at the core of that trade? And if it is, it feels like it is the catch-up trade rather than anything else.
But you know, the catch-up trade is something that we're talking about with even small caps in the States as well. The idea that the United States is seeing these heavyweights outperform, does it then show up? And then also the question of, does the bond market matter more for the stock market? Now, we keep talking about, is 5% the Achilles heel for the stock market? We're not paying a ton of attention to that read-through or that correlation.
I can't figure out exactly kind of what relationship the equity market has with the bond market at the moment. Is good news bad news, or is bad news good news? Anyway, the story yesterday was driven forward, or was it, by Jay Powell. This is what he had to say in California.
Reducing rates too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
Joining us now, Andrew Balls, PIMCO's CIO for Global Fixed Income. If you want to talk to anybody about what is happening here, Andrew is probably the best person. Andrew, great to have you on the program. Thanks for taking the time to join us. What do you think? The market can't decide. It's a coin toss as to whether or not we get a rate cut coming through from Jay Powell and the FOMC in June. Why are we still so close to that potential decision and it being a coin toss? What do you think? Why is the market so undecided? What is giving us the jitters, and what is giving us the lack of certainty that we can be convinced that they're going to pull the trigger?
Well, great. It is an interesting time. I think that Chair Powell and the committee have signaled they want to cut interest rates this year. I think the tension is that you had a clear picture the second half of last year of disinflation in the US, and then recently you've had a little bit higher inflation numbers. Now, Chair Powell again yesterday said they think this is a blip, but it will give them pause. And then the second thing I think is that the data in the US on the real side has been coming in stronger, and so again in terms of the timing of the hikes, combination of stronger data and then somewhat higher inflation recently, it still seems pretty likely that they will go the middle of this year, quite likely in June, and market pricing I think looks pretty reasonable. But there's the question of how far they will be able to go, given where the inflation data is.
Okay, so let's talk about that. How far are these mid-cycle cuts, or are these end-of-cycle cuts?
I think that's another good question. I think that you have had a different sort of cycle, the post-COVID period and everything. So looking at the historical playbook is a little bit more difficult than normal. The market is pricing in, fairly modest adjustment. That seems reasonable given the data. So kind of the mid-cycle correction. But going forward, you'll have a balance of risks around that. And I think one of the key things for us at PIMCO is to look at the US versus the rest of the world. We think that the inflation picture is somewhat clearer outside of the US. The growth slowdown is much more clear outside of the US, technical recession in the UK, Germany, and so on. And so when we look at this, the market pricing looks pretty reasonable, but the risks seem skewed towards more cuts outside of the US, further moves getting back towards kind of neutral rates, whereas in the US case, there is the clear risk on the inflation side, and maybe it is just modest cuts in the US, a slow cycle and a faster cycle over the next year or two outside the US.
Andrew, it's Creedy in London. Good morning. Put some numbers on that for us here. If we're talking about, to your point, the opportunity being elsewhere, what does that mean for very little volatility in just nominal yields? Give us a range, floor, ceiling for the 10-year.
So I think the US, for US 10 years, it looks about right. Here, 4.5% and higher, it starts to look attractive. We got close to 5% at the end of last year, and that looked like a clear buying opportunity to us. When you look outside the US, again, in the baseline, I think everything looks pretty reasonable, but the risks, the balance of risks, I think is towards outperformance of non-US duration. So again, at PIMCO, we think that Australia, Canada, the UK all look quite attractive. Europe looks okay, and there is the potential for widening of spreads, and then more in terms of the front ends of curves, more from the central bank. So we think at the moment it makes sense to tilt a little bit towards non-US duration. But then overall, fixed income looks attractive here. You were talking earlier about uncertainties in the equity market outlook with high quality fixed income. High quality bond funds give you 5, 6, maybe 7% yields. This looks very attractive at a time when there is a lot of uncertainty in the outlook, and the recession risks. Certainly in the near term, recession risks look reduced in the US. But if the Fed is not over time able to cut rates, you start thinking about the slowdown further out in the US as well. So from that point of view, high quality fixed income, I think, looks very attractive here.
You say the slowdown further out in the United States. Andrew, how do you price in the concerns around the U.S. budget? In just 12 months' time, we might have a different president, and the first thing on their docket, January 2025, is dealing with the debt ceiling yet again. How do you price that in right now?
So I think that so you can see where deficits are in the US at a time of basically full employment in the US. So you can see the significant structural deficit in the US, uncertainty around the election. But regardless of who is president, I don't think you're going to see any significant change there. It'll be interesting, of course, the composition of the House and whether it's divided government. But overall, it's hard to see much shift in terms of this structural US deficit. I think from that point of view, it makes sense for us to be in the 5 to 10 year part of the curve in the US and be underweight the longer end of the curve in case fiscal concerns start to weigh on the market. You had a demonstration last summer of the steepening of the curve, the underperformance of the long end of the curve in the US, and I think it's worth being in the 5 to 10 year part because you could see higher term premia in the US. I always think you're not going to get an exciting adjustment like we had in the UK 1 or 2 years ago. The US is a more important reserve currency, very liquid market, but the probability of a higher term premium in the long end is something that's a good idea for active managers to guard against.
Exciting, that's one way of describing it. Andrew, can I just take you back to the relative trade between the US and maybe Europe? To what extent can treasuries and bunds diverge at this point? How far can they diverge? I'm trying to work out whether or not we end up in a situation where just can European front ends come down, but actually the long end ends up being reasonably anchored by what happens with the treasury market, and you end up with disinverted curves in Europe as a result of kind of rate cuts here, but no rate cuts over in the States?
Yeah, so I think that's a good question again. So I think firstly you can test the ranges we've seen over time. This does look like real US exceptionalism in terms of the strength of the economy versus the rest of the world. I think European duration itself is not the top of our list. Again, Australia, Canada, the UK, I think you have the potential for outperformance in the 5 to 10 year part of the curve. Europe, this could happen as well, but it's not as obvious. But in these other markets, there's probably a better potential for outperformance in terms of 5 to 10 year duration. And then at the front ends of the curves, Australia, really, it's not that much is priced in. The UK, it looks pretty fair, but we would see the balance towards doing more. Similar in Canada, these are markets where they're more interest rate sensitive, which is one key difference versus the US. So I think the best way to approach this is a diversified set of positions favoring non-US duration. This has been working quite well in the last few weeks, and I think this will continue to work until we get a clearer picture in terms of US inflation and the relative path versus the rest of the world.
Andrew, how does credit perform in the scenario that you are laying out? And the tight spreads that we're seeing in credit continue, do you think?
Yeah, it's been interesting because you have seen the market price out a lot of easing led by the US compared with the end of last year, and credit markets, equity markets have performed fine. I think at the baseline that will continue. The real risk case would be if there was a risk of further hikes in the US. I think that's a very low probability. But Chairman Powell's comments yesterday, that there is a risk for the Fed in going too fast. And so he wants to guard against the risk of allowing a kind of a reinflation process in the US. So from my point of view, if they push out the market pushes out rate cuts further, that's probably consistent with credit markets performing okay. It's a real tail risk, I think, the possibility of the Fed being forced to hike rates further. But you saw 2022 that difficult process of credit markets, equity markets underperforming as we did have the big repricing for Fed expectations in 2022.
Andrew, what are the tail risks that you're watching out for right now? They center around potentially CRE impacting the banking sector, forcing the Fed to take action. As you look at the tails, what do they look like and how significant are they?
I think that when you look at the US economy, if you look at the interest rate sensitive parts of the US economy, you do see real impact. So we had the regional banking problems in the US, and there are clear problems in commercial real estate. So I think those bank loans markets, lower quality credit, more interest rate sensitive borrowers, more sensitive to the economy borrowers. I think you need to be careful there. The good news, I think, is you can remain up in quality, high quality credit, investment grade credit, senior financials, all look attractive. So it makes sense, I think, to be up in quality again. The core bond yields are very good, so you don't need to go significantly down in quality. The Fed last year, they did a very good job, I think, in terms of addressing the regional bank problems without allowing this to spread more generally. So that's definitely been a significant positive. But remain up in quality because recession risks reduced, but they have not gone away. And over time, I think it will be likely that you see the impact of tight Fed policy rates if they are forced to remain at relatively tight levels for longer. Then you start to see this more in terms of the broad economic impact. So again, up in quality in credit, I think makes sense.
Eventually, we do get a landing. Andrew, great to catch up. Always appreciate your time. Thank you for spending so much of it with us this morning. Andrew Balls, PIMCO's CIO for Global Fixed Income. Thanks very much indeed. We just had some Spanish PMI data, which I'm going to park firmly at the door of Kriti Gupta. Composite PMI rising to 55.3. The forecast there, 54.4. Again, positive data, more positive data from the periphery of Europe rather than the core.
But I'm wondering what flips that? What changes that? I mean, I can appreciate that I'm helping out. Can't help out forever. But I think I'm still kind of concerned about this is still an economy that's pushing for rate cuts. It's still an economy where volatility is still in question. What rocks the boat?
Italy, I think it could be the fiscal impulse beginning to fade, which is something to watch out for. Talking of Italy, let's look at Ferrari. Let's look at the core six and figure out what is going on there. Downgrade for Ferrari this morning. Let's see what impact that's having. Not down by that much, actually. It's interesting to see relatively LVMH a little softer this morning. But Schneider good, ASML good. The rest, we're seeing some softness there. What else are we watching this morning? Joe, over to you.
Here's this moving Solvay over in Belgium, up around 6% at the moment, was up around 8% at the open. David Hindhorn, the famed US hedge funder, buying a stake. He says it's boring, but he says that it will give you good returns. They make soda ash, as we said, in stocks to watch, which is used to make glass. So I've had a science lesson this morning. That is one of the best performing stocks we've got today. We don't know how much he's bought, but he has bought a stake, he said yesterday. And we've also bought up IMCD, also in chemicals, a bit of a discounted share placing in this one, a couple of million shares offloaded at a cheap price over in Amsterdam today. Down the bottom here, we've got L'Oreal. They're doing a deal for an Armani fragrance maker, company that sells fragrances for around 400 quid a bottle. They describe themselves as a maker of fragrances for kings. We haven't yet gotten an exact amount on how much that stake is worth, but L'Oreal is buying that company in terms of a stake there, and we're down 0.4% at the moment. We'll wait to get more details on that one. We'll take a look at these big pharma stocks. We did have news of Sanofi settling 4,000 cases related to the Zantac litigation and worries about that causing cancer. Now, there are 20,000 cases still outstanding in a Delaware court, haven't yet been resolved, so we're not seeing a huge move. We're up 0.4%. GlaxoSmithKline pretty much unchanged at the moment. That was one of the developers there. We'll take a look at miners. You've already mentioned the copper price feeding through. Lots of green on the screen in terms of miners today. Focus on the Fed comments yesterday, also on the strong Chinese PMIs. Look at that, pretty much green across the mining sector today. Glencore, Anglo American, a couple of the gainers. In terms of the ratings, as you said, Guy, it's the Birkin bags of the car sector. It's Ferrari. It is downgraded, though, at Barclays, down 0.3%. They only actually went overweight in November, and the stock's up 40% since then. So it is a valuation call on that one. We're slipping a bit today. Then we've got Lloyds. This one more positive in the UK banking space. KBW goes outperform. They say that a sell-off related to the motor finance worries in that stock is overdone, and we're seeing a rebound thanks to that KBW upgrade. They're outperform on Lloyds, and Lloyds is up 1% this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through all of the major movers that we are seeing this morning. Coming up on the program, we go back to the States. Disney CEO wins a vote of confidence. It doesn't seem the boardroom drama has had a fairy tale ending. We're going to bring you the story next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK. your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
Walt Disney shareholders have handed CEO Bob Iger a pretty big vote of confidence, rejecting dissident investor Nelson Peltz's bid for a board seat. Sources saying that Peltz won just 31% of the votes cast, the stock falling the most in more than 6 months after the results. Still up, however, 32% so far this year. Charlie Wells joined us this morning. He's all over the story. What do we need to know here?
I mean, look, this is the conclusion of one of the most expensive, one of the nastiest, one of the longest proxy campaigns in recent history. Disney spent big. They spent about $40 million treating this sort of like a political campaign. Peltz as well spent about $25 million trying to convince people that he should get on that board. And look, Iger lined up a lot of big names. He lined up Laureen Powell-Jobs. He lined up Jamie Dimon to come out in support of him. He also had to reach out to institutional investors as well as individual investors. So this is a big win for him, but a lot of his challenges aren't done yet.
Okay, so what are the challenges that he's still got to deal with? He's only got, what, a couple of years to deal with them?
Yeah, so look, he's got to go in 2026. At least that's what he said. He's previously said that before. Yeah. But Disney always has succession planning issues, and that's what Peltz was really focused on here. But one of the key things here also is streaming, right? So this is a company that is dealing with that difficult transition from linear to streaming. So they've really got to kind of change their content strategy. And look, they're saying that streaming, which has been incredibly expensive for them, could break even or hit profitability this year. Let's see if that happens or not.
In terms of spin-outs, for example, helping with that profitability story, Bob Iger was very vocal about them and then kind of quiet and then vocal again. Where are we on that?
I mean, there's been some questions that he's kind of tightening up, polishing up some of those assets. I mean, there's that linear TV asset. There's ESPN, of course. I mean, speaking about the difficulties of streaming, I mean, it's really difficult for consumers right now. And actually, Disney recently announced that they would be in a partnership with some competitors to try to bring this kind of sports streaming offer. And so a lot of questions. But look, Disney gets synergies, right? They've got parks, they've got movies, and let's not forget that parks bring in about 70% of Disney's profit. They get synergies when they've got content out there that's kind of advertising the parks and vice versa.
Okay, Charlie, great stuff. Thank you very much indeed. A whip through what the Disney story looks like. 101 Dalmatians. That's the Disney story from my childhood.
Oh, my gosh. In the commercial break, folks, I asked Guy Johnson what Disney princess came to mind. He came up with 101 Dalmatians.
There you go.
A lot of guy.
Well, it was a long time ago. The best movies of the 60s and 70s, I don't quite remember.
Was it in color?
Was
it in black and white?
Okay, now we're really pushing it. Alphabet could be about to introduce a paywall for its AI search function. We'll just talk about that story next. What does it tell us about the AI story? Where's Apple in this as well? We're going to figure that all out next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap. as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field.
U.S. Treasury Secretary Janet Yellen, they're talking about what those tensions, geopolitical story might actually look like. We've been hearing this time and time again from the Biden administration, trying to smooth some of the really tough rhetoric that they've been talking to from a domestic point of view.
Yeah.
In the Xi Biden call, that was brought up, that President Xi has been watching what's being said in the States, especially ahead of this election cycle. And it's very kind of anti-Chinese rhetoric. And President Biden is trying to smooth that over, saying, look, we don't want to discourage investment. We don't want things to be bad, but...
And it's the but that I think is important. Yellen getting on a plane, they're about to get on a plane, fly to China. She's going to be having meetings Friday, Saturday. I wonder whether she takes a more hawkish line on this. We are anticipating at some point soon that the U.S. is going to reveal the latest round of tariff reviews, and the expectation is that they could be tightened even further. And this, ahead of what you say, is going to be a likely tightening or a more hawkish style of rhetoric going into the election.
Yeah. For me, this is also a devaluation story. I think a Treasury inflow story, a export story, as we talked about with the tariffs, but also a tech story at its core as well. Huawei, TikTok were points of the conversation between the two world leaders. Janet Yellen is uniquely positioned to talk about all of these issues as former Fed chair, current Treasury Secretary, member of the Biden administration. She can kind of cover the gambit.
She is. She's also quite well trusted by the Chinese. The Chinese see her as potentially being more of an ally, and that's a relative term in terms of how they perceive her within the kind of the spectrum of hawks to doves on China in the United States. So I think that's interesting that maybe she's beginning to potentially shift more towards the hawkish side of the fence. It's interesting as well. I think you've got to see this from a European perspective too. You've got the European Union this morning kind of coming out and opening investigations into what's happening in the solar sector, what's happening in the green energy sector more broadly. The Europeans have got a very firm eye on what is happening with Chinese capacity right now, and if that capacity continues to be exported in the way that it is, then I think you're going to see action from Europe, action from the United States in the car sector, in the green tech sector, in a number of different areas. So it's not just the US that's taking a hard line. The Europeans look like they're pushing this one as well.
And I would argue even a harder line than the US is taking, to be
some
honest.
Areas,
And there have been sanctions named. There have been specific companies targeted. There has been a Russia-China read-through question, even in terms of how the EU approaches India, for example. There has been plenty of tariffs, to your point, on the EV space as well. How do you protect competition here within Europe relative to the potential question of dumping coming out of China? At least that's the verbiage that's been used by a lot of leaders. The price war continues to be a topic as well for Europe, and in terms of, do the Chinese set the prices for the European continent? And the answer, I think, right now is yes.
Yeah, but the Chinese, how long will they be able to do that? I think remains an open question. This takes us to the tech story. I think quite interestingly, because at the core of so much of this is what is happening with the technology story, which takes us to the AI story, which takes us to what Apple and Alphabet are up to, and the news that we've been learning over the last 24 hours. So Bloomberg has learned that Apple has been investigating a move into personal robotics. This is interesting because remember that NVIDIA presentation that we saw back a few days ago? Meanwhile, the FT is reporting that Google parent Alphabet is considering charging for web search features powered by AI. Let's talk about these stories in a little bit more detail. Mark Bergen joins us now on set. Let's start with the Alphabet story and figure out what is happening here. Much has been made of the fact that AI is going to be transformative, that it is going to change large areas of the economy, and that the Magnificent Seven, the big tech companies, are going to be some of the main beneficiaries of that. Does this story speak to maybe that actually that is going to be a struggle, that some of these big tech companies are going to struggle to maintain their leadership and maintain their profitability and margins as we make this transition?
Yeah, for sure. I mean, Google has the most to lose in many ways, right? They're the best position on AI. They have the most AI talent. They have probably arguably the largest data sets that they can exploit for AI. And then the ChatGPT and the generative AI explosion has posed the first actual serious threat to search in years. I think from this news this morning that they're considering kind of a premium element to search. If I was an Alphabet shareholder, I'd be more concerned if they weren't considering that. I think for a long time, Google has been trying to get away from this dependence on web advertising, which is a shrinking market for privacy and regulatory reasons. I think that exploring ways to monetize AI and search outside of advertising is really interesting. That said, they've spent years trying to do that, and they're still basically an ads company.
Is the mindset at Alphabet more in terms of R&D and kind of innovation and developing some of the technology in-house, more kind of an M&A mindset to deal with the exact challenges that you're talking about?
Oh, they can't buy anything anymore. I mean, you have Brussels to thank for that. And D.C. as well. I mean, there's a lot of regulatory pressure. I don't know offhand the largest acquisition they've made recently, but they've been mostly on the cloud side, where Google's arguing, look, we're third place, we're distant third, we're not dominant market like in everything else. Fitbit was probably the most recent sort of consumer-facing acquisition, a big one. I don't think they don't have the political will and power right now to push forth anything on M&A.
These guys are spending a lot of money on chips, NVIDIA, all the kind of kit that they're buying right now. Are we certain that they can make money off that? Are we certain that this investment is going to deliver a rate of return that is acceptable to shareholders?
Yeah, someone mentioned I thought it was smart that the company should be looking at not necessarily NVIDIA, but Intel, Samsung, TSMC, the ones that actually produce the fabs. And they're the ones that are measuring demand. And they're the ones that if the demand, this big hyped up demand around generative AI, and AI doesn't actually meet what people are talking about, then they're the ones in trouble. And from what I've seen, they think there's a skepticism that this can convert into just a massive business. I mean, OpenAI is a really good example. They seem to be having, from the numbers that have been reported, a pretty successful business on this. Yeah. The question is it going to look like the cloud computing wars, where there's basically 3 or 4 companies?
And it's commoditized in many ways.
Right. Or is there going to be one, like kind of in search?
It's interesting that you talk about Intel and the rest. Capacity seems to be a big issue. The catch-up seems to be a big issue right now when it comes to the chip story. Yes, there's the demand. Do we have the ability to make it all? In terms of making kind of AI a mass consumption product, does Alphabet have an advantage there relative to a Microsoft, relative to OpenAI itself, in terms of making your general mom and pop understand what AI is, make it a part of their daily lives, given the dominance that Google itself already has, and arguably YouTube as well?
Yeah, I think that's right. I mean, Google certainly has, I forget how many products they have, over 1 billion active users, right? They have Gmail, YouTube, Maps, all these are these huge repositories of data, proprietary data, and that's the big advantage.
But relative to to a Microsoft or an Apple, which are also huge data, consumer-facing companies,
totally.
Where does Alphabet stand in that?
Yeah, I mean, think about Apple's struggles with search. Think about Microsoft's struggles with search, right? Bing is having this kind of resurgence, but they're still well behind. And YouTube is this powerful video tool and repository that I don't think Google's really tapped quite yet on the AI front. I mean, they're just
interesting. There's no obvious kind of competitors to that as well at the moment, which I think is kind of interesting too. Just briefly, let's just talk about Apple. Everybody's getting excited about robotics this morning. what that tells me is that they're not getting excited about AI, and it feels like it's the AI story that maybe needs to develop and germinate a little bit more at Apple in order to give it the kind of the share price pop that it needs. I'm not sure a robotics going to be enough to get everybody excited about Apple again.
It's a great story that our colleagues put out. Colleague put out last night. I mean, I think AI. Apple has struggled. They haven't done anything big on the large language models front. Siri has been sort of this laggard for a long time. Robotics and home robotics is an AI story, right? In order for these robotics that people are talking about to really work and to do the things that people are, that plans and actually sort of, I read our story overnight, talked about being able to follow someone's face and identify someone speaking. That's an AI capability. And I think that Apple
but
has
do they provide the AI
demonstrate.
capability, or do they just provide the hardware? I guess is the question around that.
Yeah, that's a good question. I mean, if you look at the iPhones, they don't provide the search. Google provides the search. So Apple can do partnerships. What they can do pretty well is design. And so something that Amazon sort of tripped up in this space around home robots, and that Roomba acquisition didn't go through. So yeah, there's a question of does Apple need to do it themselves? I'm not sure.
What does the time frame look like on that? For example, the car project was a decade in the making, only to flop. Is there a time frame on what this might look like?
I mean, the home robots, I'll add this with caveat, as far as I know, like, they're not threatening people's lives, hopefully. Cars are a big, messy, and talk to anyone in Detroit, they're big, messy supply chains, and they're massively, like, regulatory problems, right? One of the major hurdles for self-driving cars has been getting it perfect. And I think they're not going to face that same issue with something like a home robot.
Yeah, Tesla, you can certainly see that.
But I will make no predictions on timing.
We've been talking about robots for a long time. Even back in the 1970s, the cartoons, maybe a little bit more focused on that as well. Mark, nice to see you. Mark Bergen joining us on the latest story out of the AI story, which kind of is dwelling in so many areas at the moment. Just not everybody maybe getting the same benefit. Coming up, you don't want to miss our exclusive interview. Brad Lightcat, the COO of OpenAI, is going to be joining Bloomberg at 4:30 p.m. London time. Looking forward to that conversation as well. The next thing we need to talk about is what is happening with this NATO 75th anniversary. This is a spending story as well. It's an AI story too. It's all kinds of different facets around this. How does Europe spend money correctly? AI is going to be part of the defense story, which is why everybody's so kind of hyped up about the security implications around all of this. How does Europe rearm in the correct way and maintain its other budgets as well? I think it's a huge challenge.
It is. I think we talked about timeline for the tech story, timeline for the defense story. This stuff takes a lot of time, and how do you plan around that? This isn't just about getting contributions. This is about, okay, well, what happens when you get the financing? Is this years in the making? Is this factories that need to be developed? Is this partnering with international defense companies, not just
in the hands of the soldiers? I think is a huge supply chain that's still got to be figured out and done so in a more coordinated way.
I'm so curious about the timeline in this and what that story actually looks like. Lucky for us, we got the perfect guest to talk about it with us. Coming up on the program, we speak to Fabrice Potier, CEO of Rasmussen Global, on European defense and NATO as the alliance marks 75 years today. That conversation next. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities, that's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. You're watching Markets Today. We are 46 minutes into the equity session. As you can see, generally green on the screen. That's what we're watching today. European markets, though, I think probably are waiting for the claims data out of the United States. And then we are obviously going to get the payroll number out of the States tomorrow. Yesterday, the tone set by the ISM and to a certain extent Powell. I'm not actually sure kind of which had the bigger effect yesterday, but certainly those two events in the States significant yesterday. A lot of Fed speak through today. The other event that we're watching so carefully here in Europe, NATO foreign ministers meeting in Brussels today. The alliance marking its 75th anniversary. Secretary General Jens Stoltenberg will be speaking later this morning, 9 a.m. UK time. Here's what he had to say on NATO providing support for Ukraine.
We are transforming NATO's comprehensive assistance package into a multi-year program of assistance. We are helping Ukraine move closer to NATO standards on everything from procurement or logistics. And we are supporting Ukraine's reform efforts to bring Ukraine ever closer to the alliance.
75 years of NATO, it's worth reflecting on that, but maybe the bigger question is where does NATO go from here, and what does the expansion in NATO ultimately look like? We've taken in new countries over the last few months. Does that continue, and is Ukraine next on the list? Fabrice Potier, Rasmussen Global CEO and former NATO Director of Policy Planning, joins us now. Fabrice, good morning. The Secretary General there talking about the idea that NATO is bringing Ukraine closer and closer. Geographically, obviously, it has been on the front line, but increasingly it feels like it's included within NATO. It's using NATO standard kit. Its communications are being integrated. Is the next logical step for NATO to include Ukraine within its borders, and how big a risk would that be?
Well, I think that's the key question, frankly. And even though we should welcome NATO putting more money, more support on the table, and moving from a backstage to a front stage role, which was until now very much the EU and obviously the US and some big member states. So this is welcome, but it doesn't change the fundamental question is when will Ukraine join the alliance? Because this is the real game changer for both European security, but also to start ending this war on terms that are positive terms for Ukraine and for us.
If we put Ukraine in NATO, it raises the risk for NATO. This is a common defense umbrella, and we're not going to change the architecture of that. If we include Ukraine, the risk of war has to increase. Is NATO, is the rest of Europe in particular, really prepared to fund NATO to the point at which it's capable of bearing that risk?
I think this is the tune you hear very much, sadly, in Berlin and Washington. But the reality is a bit starker in the sense that the dilemma we face is: do we deter Russia with a whiz, or North America, if you want, and Europe? So 100 billion euro over 5 years is substantial, but it's not dramatically changing the picture. I think it's a way to try to reduce some of the risk that the election of Donald Trump might create, but it's not going to solve it all. And countries, member states, we still have to contribute bilaterally enough for Ukraine to have the kind of capabilities, the kind of weapons, the kind of ammunitions they need to be able to hold the line. But quite frankly, I think this war will end, and will end on terms that are good for Ukraine and for us, only when Ukraine will have this complete guarantee that it will never happen again. This is when possibly the Ukrainian leadership will have the strength to make some possible compromise and to explain those compromises to the population. But if they don't have this guarantee that they will join the alliance, that they are part of the alliance, why would they make any compromise? They better keep on fighting.
But being a part of that alliance requires spending as well. To your point, the NATO itself needs that European contribution. What does, you mentioned Donald Trump and the potential re-election. What does Trump-proofing NATO actually look like? How realistic of a possibility is that?
It looks like a difficult exercise, to be honest. I think there are things we, the Europeans, can do better, starting with spending more at home, putting more resources towards Ukraine, multilaterally, bilaterally. But fundamentally, you need the United States because of the range of weapon systems available and produced in the United States, the political leadership that the United States bring to both NATO and to Ukraine, where then you will be down to what we have been seeing for the past few months, where you see very difficult European leadership and very tense leadership, I would say, between France, Germany, and to an extent Poland. And without the United States, it's very difficult to find a unity point about how the alliance can go about helping Ukraine.
Okay, let's broaden the lens and think about
compensate.
True. Let's talk a little bit about how Europe deals with this and the choices that Europe has got to make. In the scenario that you're talking about, let's say Ukraine is included, the risk rises. Maybe the risk doesn't rise, but the overall risk rises. We either leave Ukraine out and there's a risk. We put Ukraine in, there's a risk. Europe is going to have to spend some more money, Fabrice, on defense.
Absolutely.
And it's going to make sure, and it's going to need to spend that money over a long period of time. Defense companies are not going to step up and increase capacity if they think that European leaders are going to wish for a peace dividend 2 or 3 years down the road when maybe some of these challenges have gone away. How does Europe rearm? What difficult choices are we going to have to make? And do you think it ultimately is going to come down to maybe carving out defense budgets differently in the way that rules are made? Is it going to be making decisions about whether or not we spend weapons or welfare? There's going to be some really difficult decisions coming up. Do you think European leaders are capable of making them?
Well, you are spot on. I think first it requires a change of mindset from a peacetime, peace dividend mindset to a pre-war time, and to accept that now war is a possible prospect, and therefore we have to prepare for it. And this is where you will have to make some fiscal choices. That you are right. There will be some difficult trade-off between social security, welfare, but also our own security, physical security. And this is where I think European leaders have to be more forthcoming, and not just Macron and a few other ones, but all of them together. So that's one thing. Second, I think you need to see, obviously, an increase in the resources allocated to defense. We're still facing roughly a €100 billion gap in European defense spending. And I think Germany and others, and Spain and Italy, the kind of middle class of European military powers, need to go much further and to rebuild some of the capabilities they have lost. And then finally, I think here in Brussels, the European Union can play a much more active role, provided the member states agree to resource that, can play a much more active role in trying to find savings, to find multinational common projects, so that we can build the capabilities that Europe is really missing, mostly in air defense, in strategic surveillance and reconnaissance, where we really need to beef up our technology and the number of systems we have.
Fabrice, great to catch up. Thanks very much indeed for spending some time with us this morning.
Thank you very much.
Fabrice Poitier, Rasmussen Global CEO, former NATO Director of Policy Planning. While we've been speaking to Fabrice, some data coming out of Europe, France March services PMI 48.3, the preliminary number was 47.8, so that's an improvement. The comp number goes up to 48.3 versus 47.7. Germany, the services PMI goes to 50.1 versus a preliminary 49.8, so a pick up there. That takes the comp number 3 points higher as well.
I take no responsibility for France and Germany at all.
I give you time. I give you time.
We'll
but
get
look
there
at what's
slowly.
happening with the euro. The euro is spiking higher on this data.
But I think that German data is the one that they're probably reacting to the more, right? Because the last couple of data prints have been quite weak on the German front, where we have seen outperformance in Spain, Italy, and France as well. Speaking of data, we've got plenty more to watch out for in today's session. 9 a.m. UK time, we've got Euro area services PMI final data is due to be released, and at 1:30 p.m. the spotlight shifts to the U.S. Trade balances data and jobless claims coming out of there. Plus, of course, multiple Fed speakers throughout the day. Harker, Barkin, Goolsbee, Messer, and, of course, Kashkari, who's not a voting member. And we're going to keep an eye on those NATO meetings. They continue in their second day, marking their 75th anniversary. A lot to digest in the shows ahead. You are still going.
I'm still going. So yesterday, Critty carried on with the pulse. Today, it's my turn. Eric Nielsen's going to be joining us. Looking forward to his take on what is happening with the European and global economy. We're going to do fiscal. We're going to do monetary. That is all coming up. This is what European markets look like. The pulse is next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Thursday the 4th, good morning. Welcome to The Pulse. I'm Guy Johnson. I'm not Francine Lacqua. We've got some great conversations that matter on this show. What do you need to know? What's coming up on the program? European stocks, well, they're steady ahead of U.S. jobs data. Claims is out later. Got payrolls tomorrow. Jerome Powell reaffirming the U.S. Fed will likely lower rates this year. The NATO Secretary General is giving remarks later this hour as the military alliance celebrates its 75th anniversary, highlighting the tough spending decisions that Europe must now face as it looks to rearm. And this week on Bloomberg UK, our deep dive with one of the country's most prominent female chief executives. Amanda Blanc from Aviva. Looking forward to that conversation. Let's talk about what is happening with these markets right now. To be honest, we're waiting for claims. We're waiting for the payrolls. European markets broadly bid this morning. Mining stocks are doing better. That's where you're seeing the push higher. You are seeing commodities coming up. You've also had some slightly more positive data coming out of China. So that's what we're seeing across Europe at the moment. Italy flat, but you've got the CAC up by 0.2%. The FTSE's up by 0.2% as well. Let's look forward. What's happening with US futures right now? This is the picture that you are looking at there. We're mildly positive. I think we're still digesting the move yesterday that we saw from Powell, but actually I thought the biggest story yesterday was the ISM services story. The print there, weaker than anticipated, particularly when it comes to prices paid. That's a disinflationary story. Nasdaq futures up, Stock 600 up by 0.1%. As I say, that is being led this morning by the mining story. Let's talk about commodities. Let's show you what is happening there and move across to some of the other assets that we're watching. A little bit of softness creeping into crude, but we are up near 90. Look at this, Brent crude up near $90 a barrel. Gold continuing to do very well over the more medium term, but today a little bit of softness creeping in. Why are people buying gold right now? Maybe that's something that we should be exploring as well. Copper's up, euro dollar tracking a little bit higher. So over the last 10 minutes, you've had French PMI data that looks better than anticipated, particularly on the services side, and German data, interestingly enough, actually looking a little bit more positive too. So the European data may be beginning to turn just at the margin, which is interesting because it was the service data yesterday on the ISM front out of the States that saw a little bit of a slowdown. Maybe we're seeing a turn here in Europe. But the big feature of yesterday's landscape was what we saw from Jerome Powell. The Fed chair, Jerome Powell, has been signaling once again that he thinks that his central bank will wait for clearer signals of lower inflation before it starts cutting rates.
Recent readings on both job gains and inflation have come in higher than expected. The economy added in an average of 265,000 jobs per month in the 3 years through February, a faster pace than we have seen since last June. These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. If the economy evolves broadly as we expect, most FOMC participants see it as likely to be appropriate to begin lowering the policy rate at some point this year. Of course, that outlook is still quite uncertain, and we face risks on both sides. Reducing rates too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
Let's figure out exactly what he said yesterday and whether there was anything really new in what he said. Eric Nielsen, Group Chief Economist at UniCredit, joins me on set. Morning.
Good morning.
Do you make anything of that? Was anything new in there?
No, I think it was a repeat of what we heard from the FOMC and another speech. Very sort of steady story, comfortable. But yeah, sometimes it's a little bit difficult depending on how the questions come. And sometimes if you really want to read something different into it, you may be able to. I think it's the same story.
Should we be comfortable with the idea that the Fed's going to cut 3 times this year?
Yeah, I think so. It really depends on. He talked about the bumpy road on inflation, but also I think it depends a lot on what the economy does, right? If you're pacing away, as far as I can see, you're probably looking in the first quarter at something close to trend growth, down from this incredible growth rates in the last part of last year. If you're zooming along at trend, maybe we don't get quite 3, maybe we get 2 only or 1 only.
This year.
Yeah, so I certainly think that if you have a little bit of more bumpy road and the economy stays strong, as it seems has been in the first quarter, then I think the risk to those 3 are clearly on the downside.
Okay, so let's say we get 2 this year. Does that mean we get 4 next year? Should I think about the total being 6?
Yeah.
And it's just kind of 2 this year, 4 next year, 1 this year, 5 next year.
Yeah,
how do I think about how the mix works?
Yeah, I think, no, exactly. I think you want to think about where they're heading, right? And they're heading down because by all probability, you're heading to some sort of a landing of a type. Otherwise, an incredible miracle has happened in America. And maybe it has. But the base case must be one where you slow. At one stage, you have to rein in the fiscal and all the rest of it.
You think that, but maybe we'll wait and see. We'll talk about politics in just a moment. We're going to talk about fiscal a little bit later. Okay, so in theory, you're talking about a landing. But here's my question on that. Is the Fed going to deliver mid-cycle? Is this a mid-cycle slowdown that we're seeing? This is the bit that I still can't figure out. And are these cuts mid-cycle slowdown cuts? We were talking to PIMCO a little bit earlier about this, Andrew Balls. Yeah. And his view maybe that this is what we are seeing, that this is actually just a mid-cycle slowdown and we get mid-cycle cuts. You get 2, maybe you get 3, but maybe you don't get 6.
That would be incredible, right? It's possible. I mean, the way I see it, first of all, I don't like to think about it as a cycle because we have had these enormous shocks, right? Yeah. So it's not your normal business cycle rolling up and down. We had a multiple shock starting from the COVID, the fiscal expansion in America, which we'll come back to, right? And then we had the commodity price shock, which was a terms of trade gain in America, a loss in Europe, right? So we have all these things plowing through the system. So is it a normal cycle? It's certainly not a normal one. Is it a cycle where we can debate that? But the point here is that it seems to me that you're pounding along on all cylinders. The stimulus,
in America.
Only in America. Yeah. The stimulus is likely to be reduced. I know we're going to talk fiscal later on, but on Brookings' estimate, the fiscal has already had a small drag in the first quarter of the year, after having been massively stimulus before. And the monetary policy, even if they start to cut sometime later this year, the lagged effect of the hikes are still to come in and hit us. So I would argue that the U.S. probably sometime in a year's time or something is going to see a couple of quarters of close to zero growth. That's not a drama for a couple of quarters, right? But it is in that scenario, and inflation coming back towards 2%, they're going to cut rates. Is it 6 times or 5 times? I don't know, but it is a lot, right? But the big thing compared to Europe is the economy is pounding ahead, and they are a little bit more reluctant and will be more reluctant going forward.
Could you see, now let's play the game of kind of compare and contrast. Could you see 4 rate cuts this year from the ECB and 2 from the Fed? Kind of walk me through the implications of potentially what that would look like.
Let's start by this. So my opinion is that that's probably what we should have, right? Okay. And the reason is that Europe is still flat on its back. You reported just before the hour correctly that it looks like, or just now, sorry, that the numbers in Europe look a little bit better. But we are still...
But only a little bit.
A little bit. And these PMIs are still around 50, right? Yep. We are still flat on our back, maybe marginally, right? And inflation has not had a bumpy road here. We are coming down very nicely. Over the last 6 months, annualized, the European inflation number is below 2, right? 6 months, annualized, right? So it's coming down very rapidly. ECB has way too tight monetary policy. Will they do 4 this year? No, because they just can't get their head around this. They will start in June, and then we will see what happens.
Does the Eurozone need a cheaper euro right now?
I don't think that the exchange rate is massively important for Europe, but yeah, I mean,
every little helps, right?
A little bit helps, yeah, exactly. And I don't think the inflationary impact of a cheaper Europe would be a problem. So for the inflation story, because I think we are heading to 2 and probably below 2. So I think it's if you say what they need, if I were sort of the economic master of Europe and I could dictate the exchange rate, okay. Then I would take Europe down around parity. That would be good for Europe.
That would be good for Europe.
Yeah, I think so, definitely.
Is there a negative? If we're in that kind of scenario, how do I think about longer term rates? And I think the bond market is trying to figure this one out as well, and trying to understand: does Europe end up with a much lower kind of duration story, longer term rate story than the US has? Is the US just potential so much greater that we're going to end up with a big differential in terms of where the rates narrative ultimately ends up in the kind of scenario that you're painting?
Yes, it's always been about a percentage point different in sort of the arc star, whatever we kind of, whatever it is, type of thing. But that's sort of historically. And I don't think there's any reason to think that will be materially different going forward, with the caveat that it could be a bit wider. And the reason is demographics, where Europe looks particularly bad, but also productivity. Productivity numbers have been horrible. I don't think they're quite as horrible as the headline number tells you. We can talk about it separately. But European productivity is dismal, right? It's negative in the first quarter, right? So that sort of 1 percentage points difference could very well be a bit bigger. in the future.
We are going to talk about the fiscal next. I think today's a really interesting day to talk about the fiscal because I think NATO's celebrating its 75th anniversary, and I think there's a really interesting kind of take on that we need to think about how Europe is going to ultimately deliver that fiscal story. So Eric Nielsen is going to be staying with us. We're going to talk much more about what is happening with that NATO story. It's marking its 75th anniversary. More defence spending appears to be on the cards, but is that a trade-off that we need to think about? Are we going to be spending on weapons but not on welfare? And what does that mean for the European model going forward? We'll talk about that next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Minutes past the hour. Welcome back. This is The Pulse. I'm Guy Johnson in London. Francine Lacroix off today. Let's talk about what is happening in Brussels right now. NATO foreign ministers are meeting there. This is the alliance marks its 75th anniversary. An opportunity maybe to look back, but certainly an opportunity to look forward. Can Europe afford to do what it needs going forward to support NATO? Defense spending is critical right now, but how does it ultimately get paid for? And are we going to have to, potentially here in Europe, if we are going to fund defence spending, sacrifice in other areas? For instance, what is happening with welfare? What is happening with the energy transition? These are key questions that Europe has got to figure out. Let's pose that question now to Eric Nielsen from UniCredit, who is still with us. I think this is a great opportunity to talk about the priorities of Europe. Right. Europe, we're celebrating 75 years of NATO, an organisation that has provided the security architecture for Europe. A third of European members, of NATO members in Europe, still don't match the 2% defence spending. They're going to have to, certainly if Donald Trump comes through. That is going to be a floor, not a ceiling. Are we going to have to make some really big decisions here in Europe about where we spend money and how we spend money? Is it weapons over welfare?
We have to make big decisions. let's start by the bad news. I think 2% is probably the low end. That was a number that was established in peacetime, and now we have war on our borders. So you could easily argue for 2.5% or 3%, thereabout. So you're looking for defense. To get there, we spent about 1.5% on average in Europe last year, a little bit less. So let's say that you need 1 to 1.5% of GDP in extra spending per year, right? That's a lot of money, but it's not impossible, right? It's definitely feasible. I would argue that there are two ways of doing it. You can either, as you implied, you can find other things to cut. That's politically difficult. Let's be very clear. I'm not a politician, but I can watch how hard it is to cut spending. Or you can raise taxes, also very difficult. Or you can borrow the money. My argument, and what I think is happening in Brussels, is that they're looking increasingly towards borrowing it collectively, because it's a collective obligation in a sense. Of course, that debt has to be serviced one day in the future. But it comes on the sidetrack with this beautiful thing that if we had more European debt, we also had suddenly a risk-free European asset or euro asset, which would get a lot of other good things coming on. So I have long been an advocate for borrowing collectively what is collective issues.
So that would include. So we started off with the pandemic. We did it then. That was the kind of we broke the ground on that.
Exactly.
If there were, and at the time I was told, I talked to a lot of politicians about this, it was a one-off.
Yeah.
But if it's not a one-off, it starts to become more normalised. So you start to create that asset class. Would green spending be included within that? Would that be something that we should do more of as well there? What other things could be included?
Yeah, I think those are the two obvious ones, defence and green spending, right? It's impossible to argue that any one country can do defence or green spending alone, and it's like pollution that goes all over the borders, and the defense is the same, right? So I think those are the two obvious ones, but we're not there yet politically for whatever reason. So it will take time.
Can we get there? Because this is, you and I have talked a lot about this in the past. Europe struggles with speed, but it feels like speed is of the essence right now.
Yeah. So, I mean, you mentioned it before. I mean, the obvious trigger is Donald Trump winning in November. And then saying some of the many crazy things he says about Europe and NATO and all the rest of it. That probably could energize Europeans to say we have to do it ourselves. But then by the time you agree to spend the money, issue the money, spend it, build the capacities, and it's not only a matter of building tanks and weapons and stuff. It's technology, right? And we don't have it in Europe, so it's a massive task ahead. And as you said, speed is of the essence. And the problem is we sometimes in Europe we are so scared of making a mistake in this. So we build by consensus and we wait and wait and wait, and instead of plowing ahead and then correct mistakes as they inevitably will happen. But that's what.
Do you think it's countries like Italy that I think it'll be interesting in this process? This presumably would be good for Italy. This would be good for countries like Italy, which look like they're coming off potentially quite a lot of fiscal spending right now, and they're going to have to potentially pay that bill maybe sooner rather than later. Do you think that everybody is going to be on board with this? Do you think Germany would be on board with this? I can see countries that would be on board with this, but is everybody going to be on board with this, Germany in particular?
I think you're right, pointing or asking the question about Germany particularly. They certainly have the industrial capacity. They have a good deal of the technological capacity, but they have a political kind of a hangover that they worry about being seen as least speaking, right? So it's as a German politician once said to me, it's difficult to be a German politician because they want you to lead. When you then in one space start to lead, and then we don't want you to lead in that direction, we want to lead in that direction. So what do you want, right? So it's very difficult. Unfortunately, we may have to have a bad event, a Trump election or an expansion of the war for Europe to really get its act together.
We'll watch. Eric, nice to see you this morning.
Good to be here. Thanks
for the analysis on this. Eric Nielsen, Group Chief Economist, Economics Advisor over at UniCredit. Okay, where are we going to take you next? Google reportedly weighing fees for AI-powered search. We're going to take a look at what this could mean for its business model going forward. That's next. This is Bloomberg.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. You're watching The Pulse. I'm Guy Johnson. Let's talk about the tech news that we've been getting out over the last 24 hours. A couple of stories that I think are really fascinating. Alphabet reportedly considering charging for web search features that are powered by AI. Alex Webb joins us now to discuss this. We're spending a lot of money. These companies are spending a lot of money right now on buying chips from NVIDIA, making their AI work. It's expensive. Is this an example of them struggling potentially to monetize it, to make money from this? And how big a challenge could that be?
Well, I think a lot of the spending they've been doing from NVIDIA in particular on data centers is actually to do with their cloud business. They want to sell a lot of these features to companies that want to use AI features themselves. But at the same time, Google itself, its core business, they're trying to pivot the whole business towards AI. As you say, it is hard to do it for free because each search at the moment, or each AI query, can cost a few cents to process, right? Depending on what it is, depending how big it is. And so you can't afford to do that at scale for whatever 3 billion people doing searches every single day. At the same time, if you are charging, that kind of caps your upside. There's a reason that Meta, Facebook, doesn't charge to use its services. It's because in the US, in some years or some quarters, it makes like the equivalent of $20 a month per user. So if you're capping the ad-free version at $10 per month per user, and it's not something investors will necessarily jump at. So there's an interesting thing to be balanced here of how you kind of... Now, sorry, one caveat is that over time, that cost will come down. So maybe it's that you charge to begin with, and then gradually as the costs come down in the years ahead, then you can remove that paid tier. But for now, it seems like it's the only way to cover your costs.
Great story out of Bloomberg overnight, talking about the fact that Apple is looking at robotics as being, rather than cars, it's going to be looking at robotics. Just tells me that Apple's a hardware company, not an AI company. Is that the correct read of this?
Yeah, I think so to an extent. Like Apple, firstly, huge caveat again, Apple does lots of research projects that never come to anything, right? Yeah. And sometimes gets quite a long way down the garden path before giving up on it. But AI is a software thing. This is trying to find a way of putting automation into hardware. It's going to be very expensive for the end consumer. It's hard to see the use case.
Alex, great stuff. Thank you very much indeed. Bloomberg's Alex Webb. What have we got next for you? Our interview with the Aviva CEO, Francine Lacqua, sitting down with Amanda Blanc. We're going to talk about consolidation, diversity. All of that is coming up next. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Good morning and welcome to Bloomberg UK, which is a special focus on the biggest challenges facing the British government, the British economy, the British financial services sector and markets. I'm Guy Johnson in London. Good morning. Today we're bringing you a deep dive into one of the country's top female CEOs. Aviva's Amanda Blanc is one of the few women leading a blue chip company in Europe. Soon after taking charge, she led a project to slim down operations and pledged to reverse a share slump. Almost 4 years on, and the stock has gained more than 30%. Now, Bloomberg's Francine Lacroix spoke to Amanda Blanc about consolidation, the impact of AI and climate change on the industry, as well as opportunities for future growth.
If you think about workplace pension, we have a sort of 23-24% market share. But the thing is that that market continues to grow. We know that DC pensions will grow from the 500 billion it is today to 1.2 trillion by 2030. So there's plenty of growth opportunity. The wealth opportunity aside pensions is significant. So we don't see any lack of growth opportunities here. I think it's making sure that the business is really well positioned to be able to capitalize on that.
I know you're also extremely involved with, reforms in the City of London, some of the things that the regulators have been trying to push through. What's the right prescription for the UK to grow? So when you look at risk-taking and growth, do you need a strong reform of the pension market?
So I think in the pension market, what we would encourage is that there's more focus on advice. And today, only 10% of people actually take any advice because it's expensive, they don't think advice is for them. Whereas 70% of people want advice. So there's clearly something wrong there. So we are very, very big advocates of this work that's going on currently with the regulation, with the Treasury, to encourage people to take, some sort of advice. Even if it's, a person like you bought products like this, to just encourage individuals to really think about that. The other area, I think, where the regulators can help is in the businesses that we can invest in, where we put our capital to use to get good returns. And the Solvency II reforms, which we've heard a lot about, and will, I think, really help companies like Aviva. We've committed 25 billion of investment into UK infrastructure over the next 10 years as a consequence of those reforms. So I think those are really important things that can help.
But is there something in the U.S. market? I mean, they have the 401k. It's just a different, I guess, appetite from citizens and risk. There's a lot more retail investing. Is that a good template for the UK?
Well, whether or not it's a good template, I think definitely the culture is a good culture. Because what you see in the US is that people are engaging more with their savings. They're thinking about the businesses they want to invest in. Whereas in the UK, you know, in your defined contribution pension, something like 93% of people will just take the default pension. They're not thinking about what they want to invest in. So I think there is a definite role for more financial education, more understanding of what you're investing, effectively what are your savings in.
How much are you thinking about AI? And is that really going to be transformational for your industry, or is it already infiltrated, right, through algorithms and some of the websites and technology that you have?
I mean, AI already plays a massive role. If we think about motor pricing, you know, it's all done by machine learning. It's very clever. It's very dynamic. And we've been using that for many years. We're using chatbots. We're using AI in, you know, some of our financial reporting. There's a lot of already within the business. However, you know, every CEO that you speak to, every commentator, everybody's talking about what's the future role of AI. And I think we are doing quite a lot of pilots in different parts of our business around thinking about how can large language models really help us, for example, in handling claims, in assessing documentation. Those are, you know, some areas. Clearly, there's a much bigger role as we go into the future, but I think I'm more of a believer that this will happen in waves rather than, you know, it will be a fundamental switch, you know, one day in the market where suddenly everything will change.
But is that transformational to attract business, or is it transformational to actually look at claims?
I think it's a combination of all things. I think it's basically making the business more efficient, which means clearly that's better outcome for customers because you can deliver the product to them more cheaply. But it's also the way you can analyze the business and you can make good decisions. So I think it's a combination of all things. But ultimately, if we think about some of the systems that we have today, you know, if we get those onto more agile platforms using AI, that's a better customer experience as well in the interaction with Aviva.
And so does that mean you get also more business from the same customer, or you're able to, I guess, to take advantage of, you know, solvability for these customers?
For sure. I mean, I think obviously our aim, because we can be with the customer from the very first junior ISA to the equity release mortgage that they may do at their sort of end of their retirement, we do believe that if we've got, you know, more agile technology, more ability to understand where a customer is in their life journey using AI, then clearly we can deliver better propositions.
Amanda, when you look at some of the, I mean, you know, putting insurance on things is not easy. So you have climate change, you have natural disasters, you have disasters, for example, like the ship that went into the Baltimore Bridge that took it down. Like, how difficult is it to look at these man-made or not man-made disasters and decide what kind of insurance premium you need?
Well, of course, you know, the thing is that in many cases, particularly in general insurance, you only get to use the product when usually something bad has happened. Insurance is there to build back, to help to recover. So that's how you use your product. But I think we're constantly having to assess what's the impact of climate change, what's the impact of biodiversity. You know, all of these are areas which will go into our pricing of our models, because ultimately, of course, if climate change continues in the way that it does today, then things become uninsurable. So it's very much in the interest of insurers to make governments, make customers think about, you know, decarbonisation and how they're thinking about their transition planning.
But you are there actually in times of need, actually, as an insurance company.
Yeah.
But do customers see that?
Well, I think insurance can sometimes get a bad reputation. Sometimes that's self-inflicted, by the way, you know, in the past. But I do genuinely believe that when I look at the experience that our customers have, you know, for example, in a bad flood, where effectively your home is uninhabitable for many, many months, and we're able to put people into rented accommodation, provide them with, you know, clothing, furniture. The response that you get back from that is, you know, I'm really glad that I'm insured with a reputable company. Yeah. So I think it's only when you actually experience the product, that's when you really see the value of the product. And, you know, and then that's usually when something bad happens, particularly in general insurance.
I mean, insurance, financial companies, financial services seem to be getting bigger because there's a lot of consolidation. Do you expect that also within insurance?
I mean, you've seen that in insurance. I think, if you take our own example over the last number of years, whilst we haven't done big M&A, we've bought a wealth advice business, we've bought an additional protection business, we've entered into the Lloyd's market. I think you will see more of that for sure, because scale is really important, because scale gives you, buying power, it also gives you diversification.
I mean, do you spend, and I know you don't want to talk about speculation, but do you spend a lot of time looking at whether you're a takeover target or whether you want to buy something, or how do you navigate it as a listed chief executive?
I mean, I think you would expect us to see most of the things that come onto the market will pass over our desk at some point. We will look at that, but I'm always looking at this is this the right thing for Aviva? Is this going to add value to Aviva, or is it going to help us to deliver value for our shareholders? And that can be around synergy. So, is it going to help us to be more efficient, or is it going to fill a gap that we don't currently have today? So it's strategic, and I think you will look at M&A differently depending on those two things. But I think we've been very clear that for us, M&A has a high bar, and so we're constantly looking at it, but it would have to be a quality acquisition.
Quality acquisition. We're going to bring you more of Francine's interview with Amanda Blanc after the break. They're going to talk about diversity, sexism in the city, and what that means for leadership. That conversation next. This is Bloomberg.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg UK. Good morning, everyone. I'm Guy Johnson in London. Let's talk about what is going on over at Goldman Sachs. Goldman Sachs reportedly set to reveal that its gender pay gap in its UK operations actually widened last year. The Financial Times is reporting that the mean hourly pay difference between men and women at Goldman Sachs' main UK entity rose to 54% from 53.2% in the previous year, i.e. it's going in the wrong direction. The FT says that is the highest it's been in over the last 6 years, which takes us back to our conversation with Aviva CEO Amanda Blanc. Amanda is also a champion for equality and diversity in Britain. Bloomberg's Francine Lacroix asked Blanc if she's disappointed there hasn't been more progress on this front.
I think you'd have to say yes to that, because, if you're looking at the FTSE 100 and you have 10 female CEOs, 90 male CEOs, you have to say, I mean, something's not quite right about that. And if we look in financial services, and I'm the government's Women in Finance Charter Champion, we're seeing 1% improvements year on year. Now, that's good, and we should celebrate that, but it's not quick enough. So I think we have to have a look at, what's going wrong, and it's really the pipeline of women, if I talk about gender, women coming through, that is not strong enough. So we have to make sure that we keep women, at work, being promoted, but always the best person for the job, but making it easy for families for the man and the woman to be able to work.
But is that flexibility? I mean, I know there's been, and you've testified, and we saw the episode with the Garrett Club. Is it still easier for a man to do business in the city?
I'm not sure it's easy for a man to do business. Look, I think we have seen definitely some bad behaviours, and certainly I asked for women to contact me prior to giving evidence to the Treasury Select Committee and heard about lots of very, very bad experiences. But I think what you have to do is get shared parental leave right. If you're looking for what makes it easier, at Aviva, 80% of our men take the full 6 months of parental leave. Now, I think that sets then the tone right from the very beginning of childcare responsibilities, that is a shared responsibility. That makes a really big difference. I think at that point, it then becomes easier for the men and the women to do well. And what we want clearly is for both to do well.
But so is that more important than sexism in the city? I mean, I was fascinated, for me it was a watershid moment, because this was on LinkedIn, and you say, I would like to hear from testimonies of people that have had, allegations, either assault or bad experiences being a woman in the city. That was quite powerful.
Yeah, it was powerful, and I mean, it was very emotional, actually, because I hundreds and hundreds of private messages from that. So you do still see that some women are experiencing bad behaviour, and that is clearly wrong, and that has to be dealt with by organisations. But I think there's the behaviour point, and then there's the sort of systems, processes that you put in place to make sure that opportunities are available for both men and women to succeed. But I think the behaviour has to be dealt with. It has to be dealt with by organisations, and women have to feel that if they speak up, that will be dealt with.
Do you think that's gone backwards, actually, that less people want to speak up?
I'm not sure that it's gone backwards. I think that people are now more prepared to call it out. So you are seeing more examples of that. It's hard to say if it's gone backwards, because I think 10, 15 years ago, you wouldn't be hearing about this at all.
I mean, there are also a number of diversity initiatives that the government said, well, actually, we're not doing it in the right way, we're wasting money, and it's not having much of an impact. How do you look at that?
I think the danger with a lot of these things is that there's about 50 different initiatives within any organisation even, and effectively then you lose focus and you're not concentrating on what is actually going to make the biggest difference. And I think at Aviva we've spent some time really focusing on what are the things that make a really big difference. So it is shared parental leave, it is sponsorship programs, it is making sure that you've got access to all of the roles, that effectively that you are encouraging access to all of the roles that are available. Those are the things I think you have to focus your attention on.
And is it something that, do you feel like UK PLC is actually listening, even if without government incentives?
I do honestly believe so, because I think that if I speak to whether it's other female CEOs or male CEOs, everybody realises that a diverse workforce makes better decisions, looks after customers better. If I think about Aviva's 19 million customers, they are from all walks of life. And therefore, if you've got an organisation which doesn't reflect that, you're not going to build big, good propositions. You're not going to make good decisions. So you have to have that represented. I think everybody gets that. It's between the getting it and the implementation of the strategies, I think sometimes things can not happen.
And when you look at leadership, what does it mean being a leader, being a chief executive in 2024? Is it different to what it was like 10 years ago?
I do actually think it's different. So if we think about, maybe go back 20 years, leadership was much more command and control. It was much more, trust me, I'm the CEO. I think there was less accountability, and at least, you had longer, if you like, to deliver. I think today, CEOs are thinking about, well, what do their colleagues think? What do their customers think? What do their investors think? And I think the pace is really quick. And you have to be able to communicate really, really well, effectively. You have to be simple in your strategy. Yeah. You have to get things done. You can't afford to take time. You have to be able to act decisively.
But that's difficult.
Yes. Well, is it? I mean, doing what you say you're going to do, is it really that difficult? I think the environment is difficult in that everything you do is judged, and it's judged pretty quickly. But everybody's living by the same rules, effectively. So it's not like you're being judged any different to, any other CEO. But I think that, this, you need a big strategy, and it takes months to deliver that. I think sometimes we overcomplicate it. If you know your organization, if you know your industry, if you know your business, you know what needs to be done. And then it's a question of gathering the right team around you that have the same beliefs, that, think the same, think that there's the same way of doing things, and just getting on with it.
So what's the hardest bit of actually being a chief executive of a listed company? Is it building? Is it building your, your troop? Is it building your board? Is it trying to get things done? Is it convincing, everyone in the business?
I think it's a constant. It's a big communication role being a CEO, isn't it? You have to communicate to your investors, to your board, to your colleagues, to your customers, that this is a good company, that this is worth investing in, whether it's your time, your product, or your money. So I think, is it a harder job than other jobs? I don't know. It's a full-on job. It's a 24-hour-a-day job. There's not a minute of the day where you're not thinking about Aviva, or what's going on. How could we respond to a different opportunity in the market? Challenging yourself, that you're constantly reinventing the organization. But I love it.
That was, of course, the Aviva CEO, Amanda Blanc, in conversation with Francine Lacroix. Meanwhile, the asset manager Aviva Investors, part of the insurance group Aviva, is tapping Australia's pension fund to partner on private deals in the UK and Europe. As the surging pool of retirement savings there lures more offshore suitors. The firm, which manages 262 billion euros of assets globally, has been talking to some of the funds about co-investments in logistics centres, residential development, in its push to double its real estate asset portfolio over the next 5 years. And be sure to subscribe to Bloomberg's In the City podcast. That's with Francine Lacroix, along with David Merritt. You can find it on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes every Thursday. Coming up, we're going to take you back to the NATO story. We're going to get the latest lines from the NATO Foreign Ministers meeting. The alliance marking its 75th anniversary today. More on that next. This is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Minister Kuleba, Dimitro, welcome back to NATO. It's always a great pleasure to welcome you and to see you here. And let me start by once again recognizing the courage, the determination, the bravery of the Ukrainian people, the Ukrainian armed forces, and you personally in standing up against Russian brutal aggression against Ukraine.
Thank you for your personal efforts and forward-looking approach when it comes to initiatives how to ensure sustainable financing and support to Ukraine.
The NATO Secretary General Jens Stoltenberg speaking alongside the Ukrainian Foreign Minister Kuleba in Brussels. The alliance there marking its 75th anniversary. Some big questions that need to be answered about its future. And the NATO Secretary General will be doing just that. Jens Stoltenberg will be joining the surveillance team for a live interview tomorrow. Plenty to discuss. Aid to Ukraine, the prospect of a Trump presidency. Who's going to replace Jens Stoltenberg? That interview tomorrow, 12:30 p.m. UK time. As I say, NATO foreign ministers are meeting in Brussels today, the alliance marking its 75th anniversary. Some key questions that need to be answered about where NATO goes from here. Let's bring in Bloomberg News Director for Europe, Middle East and Africa, Ros Matheson. In terms of the UK position, we've got David Cameron, the Foreign Secretary, delivering a speech in Brussels later on. What message is he going to take to his colleagues when it comes to the UK's position on whether or not Ukraine should be given more aid, and ultimately whether Ukraine should be allowed to be part of the organisation?
Well, the UK has been one of the biggest allies and supporters of Ukraine since Russia invaded, including sending weapons and arguing the toss always to send ever stronger weapons, longer range weapons to Ukraine. But really what David Cameron's speech is about is those questions you mentioned, the fundamental future of NATO. What is the role of NATO going forward? And he argues that, for now, Europe, the UK, NATO are in the same moment with Russia in a way that the UK and France were in 1938 with Nazi Germany, the sense of not appeasing a nation to avoid a broader war, saying that Russia, Vladimir Putin is a tyrant, in his words, who cannot be appeased. And in a way that NATO also needs to make the case for NATO, that NATO members have to keep arguing and explaining why NATO is relevant, what its role should be, and that it should remain unified, particularly when it comes to Ukraine, because we are seeing those cracks emerging amongst some member states, potentially the US also, going forward about what the role should be with Ukraine. And the conversation at this meeting is really about that question of Ukraine.
There's talk in Brussels of joint funding for European security. What role would the UK play in that?
Well, certainly it would be an advocate, because at a member state of NATO, they'd all have to contribute. That's how this $100 billion fund for Ukraine, for example, would work. And the idea that also more broadly for self-defense, these nations need to be contributing a proportion of their own budgets to NATO. So you need every member state to agree to that. The UK is probably going to be one that signs up to it. But what we're hearing, of course, is that Eastern European nation states, others are far more cautious about it.
Ros, great stuff. Thank you very much indeed. Bloomberg's Ros Matheson. And another reminder to subscribe to the podcast In the City. You can find it wherever you get your podcasts, In the City. Much more to follow. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight, because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Good morning from my world headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Powell signals the Fed has time to assess the data before deciding on rate cuts.
On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Apple explores personal robotics in the next big bet as that car project fizzles. And the Disney CEO, Bob Iger, won the proxy war, but now he has a battle of unresolved challenges, from the struggling movie business to finding his successor. A very good morning. The soothsayer that is Jay Powell, reaffirming the cuts are coming, fear ye not. And that, to a certain extent, took the bond market ratcheting off the boil and gave some spirit back to the equity markets this morning. In terms of flow, Citi are saying there is persistent risk demand for equities and momentum. It may be shaken a little bit this week, but the fundamental flows into equities are there. $16 billion in net long. So we are just seeing a rising tide this morning. We're counting down to the jobs report tomorrow. It's interesting in terms of those stocks that are moving. Meta has a nice bid this morning. That is more on the back of an upgrade from Wells Fargo, seeing 20% upside in the stock. The stock is up 1.25% this morning. The robotics headline in Apple, everybody was sort of pretty much, yeah, they're not that bothered, or perhaps they lack belief. So the cuts are coming. That is the deja vu. John Arthur's encapsulated it beautifully. You have deja vu. They're coming, they're coming, they're coming. Just calm down and wait for them. But have a look at the bond market, because the bond market waits for nobody. It saw prices paid yesterday come in at a 4-year low, and that is what it took it off the zenith. Still over the 4 trading days of the week, you're up 15 basis points. We were up 22 basis points at one juncture yesterday. It's all just a bit vague. I love what BMO, Ian Lingen had to say. All the waiting and no seeing. So these are inflation bumps, according to Powell, and we must all be stoic and calm down. And with that in mind, Chair Powell signaled that the Fed is still on that rate path amid recent inflation figures.
These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path.
Well, my next guest says this. I'm going to take you back to a pretty horrible period of time, 2007. The Fed had aggressively hiked in 2005 to 2006 and went for a long 15-month pause. Pretty much the same as what's happening now, with the first Fed cut continuously postponed and a long pause happening. What happened after in 2007? Well, some of us lived through it. It was a pretty torturous time. Alfonso Picatiello is the CEO of Macro Compass. So I went back and I read the New York Times article when they cut rates in 2007. And they were cutting, to quote the New York Times, it was a bold acknowledgement that the mortgage market was in meltdown and plaguing Wall Street and Main Street. Alfonso, it is not 2007. Growth is firm. We do not have a crisis. Therefore, sir, I put it to you, this is not a 2007. We should not be correlating to them.
So I would say, Manners, that my, let's say, way of checking today's scenario against 2007 is more driven to the fact that the Federal Reserve back then ended up cutting interest rates by 50 basis points, despite core inflation, core PCE was annualizing over 2.5%, and the job market in the United States was still printing about 120,000 jobs a month on average. And in that scenario, the Federal Reserve, after a long pause, decided it was scared enough by some initial issues in the housing market and the mortgage market to come up and cut by 50 basis points. So what did the market do back then? Well, you had a big curve steepening. You had a big rally in gold, in oil, in commodities. You had the energy complex doing particularly well. And you had the stock market, specifically large cap, like tech stocks, for example. They did pretty well, thanks to the proactive easing from the Federal Reserve. Now, this time, the Federal Reserve is talking about cutting interest rates about 3 times this year, and maybe 3 to 4 times as well next year. So it's a proactive cutting cycle that is happening, again, on the backdrop of what? Well, core PCE is annualizing 2.5%. The job market in the United States is not weak enough to generally come with a cutting cycle. So the private sector is adding over 200,000 jobs on a 3-month rolling basis as we speak. And nevertheless, the Federal Reserve is talking about interest rate cuts. This time not because the mortgage market is under pressure, but most likely because of politics, if you ask me. They want to get started before the election cycle gets very heated. And the market is behaving exactly the same way it was behaving in late 2007 from a commodity perspective. And also, I think the bond market is waking up to a steepening, which should happen if this is what we're going for.
So it's politics, not crisis, not an event-driven risk that will invoke this cycle. Okay, I mean, that is a moderately contrarian view. Powell himself talks about a restrictive. He's used the word restrictive. How restrictive are rates, given that FCON is pretty loose?
Well, that's a bit of the situation, right? If you ask the Federal Reserve, they would say conditions are restrictive because they look at a set of data, like, for example, lending to small firms, which has been coming down. But if you look at other metrics of financial conditions in market, it's hard to say that things are loose when meme coins called dog with hat is going up 3,000% over a weekend, Manus. I would hardly call this restrictive. Now, the situation is the following, that rates are restrictive, but specifically they are restrictive for countries outside the United States that have equilibrium interest rates and a structure of their private sector which is not as well as equipped to handle higher interest rates like it is in the US. So for example, can we say that interest rates are restrictive in the UK or in Europe or in New Zealand or in Sweden? Yes, they are. We are seeing in these countries growth coming down, inflation coming down aggressively. So when you're looking at the restrictiveness of monetary policy breaking something like it did in 2007 with the US mortgage market, I would encourage people to look outside the United States, not in the United States.
Well, your thesis portends to that if something breaks, it will break beyond these shores. What is it in the credit markets in Europe that irks you so? And can it be anywhere near the scale of what we did see as the torch paper was lit in 2007 and a mortgage crisis here in the United States?
I would say the size of the potential credit crisis, if we want to talk about Europe, can't be the same size of 2007, simply because the amount of regulation that has been put through, especially for European banks, but all over the world, is quite impressive. So you start from a safer regulatory standpoint than you were in 2006 and 2007, but nevertheless, I want to invite the audience to reflect on the fact that most corporates in Europe do not obtain funding through capital markets, they obtain funding through the banking market, so through lending, direct lending from banks. And now these loans were generally, 5 to 7 to 8 years maturity, and they were mostly concentrated in the period when quantitative easing in Europe was running loose. So anywhere between 2015 and 2017, corporates in Europe, even triple-B corporates, could borrow for 7 to 10 years at very, very low interest rates. We're talking about 1.5 to 2% all-in borrowing costs. And today they're rolling over this funding at much, much higher interest rates. Some corporates are already under pressure.
So then this takes us to the thesis that we've been running with on Bloomberg through the week, that there will be a divergence between the scale and the pace of the Fed cuts relative to the ECB, relative to the UK. Translate that into spread trading for me. Is it bonds to bunds? Is it bonds to gilts? Where is the biggest outperformance in terms of those spread trades? I'm assuming that that's how you play it.
Yes, I think the best ways to place these are in the FX market and in rates markets. The rates markets I like to receive the most right now are Europe. New Zealand is a market that I really like to receive. I think the situation there is also precarious, and Australia. These are the three countries that I like to receive the most, where I want to pay the US against it. You can also play that in FX. The Aussie dollar or the New Zealand dollar do not look particularly well here.
And in terms of the commodity, I like the way you reflected on it as you bolstered your thesis, which is good to hear. You talk about deja vu in the commodity market. I look at gold. We're going to check these prices a little bit later on. Silver's the highest in a couple of years. Gold's making record highs. Oil is up for geopolitical reasons. But in terms of the additional plays, it is in commodities, isn't it?
Yes, I mean, if you're an investor, Manus, and you're looking at nominal growth north of 4%, so real GDP growth above 2 and core inflation around 2 or above 2. And then you're looking at the Federal Reserve coming in with 6 or 7 acts over the next 2 years, despite a strong nominal growth. What do you buy? Where you buy assets that do particularly well when nominal growth is strong and the Federal Reserve is easing and compounding this strength. Well, commodities, cyclical stocks. This is exactly the same that it happened in 2007 in the second half, and I'm not surprised it's happening again.
Let's just circle back. I like what Ian Lingen had to say over at BMO. He said, all the waiting and no seeing from Jay Powell. So we've had 2 moments of rhetoric. We're kind of down to the jobs report tomorrow. These bond markets in the US have been jolted this week, and yet prices paid come in at a 4-year low on the services number. Does that reassure you that we could be incrementally getting closer to the start of the cutting cycle? And if so, what scale will that be?
Oh yes, the Federal Reserve will start cutting in June, I think, simply because they want to get started when they have a new dot plot, when they have a new set of forecasts, and early enough to not be caught in the crosshair of political and election discussion. So June sounds pretty much about right for me. The fun thing is that June the Federal Reserve will start cutting in June, despite the economy probably still doing okay from a nominal growth perspective. And, for me as well, the Fed starting in June gives so much leeway to other central banks. The Swiss National Bank is already gone. That also gives cover to central banks like the Bank of England or the ECB to start cutting interest rates. And I think their cutting cycle will by far be larger and much, much faster than the US cutting cycle. And that is, I think, the trade in bonds, much more than focusing on the US, where the steepening is actually my preferred expression.
So the steepener is there. Do you think that real money came in this week? And you see these jolts above 434, 435. Some people are saying that's a ceiling, up to 450 on those ratchet higher in yields. Is that where real money comes in and buys? Do you believe that thesis, or is that just something being sold to me by the sell side?
Well, I would say as a former institutional money manager, I can tell you, Manus, that there are certain regulatory incentives at some point to come in. If you're a large pension fund, for example, okay, and you're looking at 30-year BBB corporate yields. So you can buy a corporate bond, 30-year maturity in the United States, and it's yielding 6.5%. That's roughly where we are today, okay, 6 to 6.5. You have your liabilities to immunize as a pension fund, right? And if you have a target return of 7% today, you can achieve that without taking any equity exposure. You can simply buy long-dated corporate bonds because 30-year rates are high and credit spreads are, let's say, decent. You can buy at 6.5% and you immunize your interest rate risk and you get your target return simply by buying long-dated corporate bonds. So yes, real money should be coming in at a certain level of yields in the long end.
Alfonso, thank you so much for being with us this morning. That is Alfonso Peccatiello, Macro Compass. You can pick up his tweets and get his research. It comes in my inbox every single morning. Other stories that are trending on your Bloomberg Time Up this morning. This is what we've got. Benny Gantz is calling for an early election in Israel, ramping up the pressure on Benjamin Netanyahu. The War Cabinet member says polls should take place in September instead of as scheduled in 2026, and that would help prevent the rift in the nation. Swiss inflation unexpectedly eased, vindicating the SNB surprise rate cut last month and suggesting more might be coming. Consumer prices rose 1% from a year ago in March. That's the lowest reading in 2.5 years. Economists have predicted an acceleration of 1.3%. The Carlyle CEO, Harvey Schwartz, earned about $187 million in his first year at the firm. Schwartz has been tasked with steadying Carlyle for growth, boosting performance of key strategies and bolstering its stock price, which had lagged behind the biggest publicly traded rivals. BYD plans to launch its first electrified pickup truck. That's for the global market later this year. The vehicle could challenge Toyota's Hilux and Ford's Ranger. Photos released by BYD show a boxy dual-cab truck being road-tested in an unspecified location. Now, while the company didn't release any details on the powertrain, performance, specifications, and pricing, it's said to be a mid to full-size truck, and it will be the first new energy pickup. Coming up in the show, up on its car projects, Apple has eyes on what it believes are the next big thing: a robot, your next best friend. And Bob Iger's challenge remains, even as Disney, the CEO there, wins the proxy war. More on the challenges ahead for Bob Iger on Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
This is Bloomberg Brief. I'm Menace Cranny in New York. Well, after its car project failure, Apple is now moving towards robotics, which it believes has the most potential in the future, according to people familiar with the matter. Joining me now is Bloomberg's Kriti Gupta. Kriti, good to see you this morning. So the car didn't go so well. They spent a long time and a lot of money. Now I'm going to get a new buddy, a new friend from Apple, a robot.
I mean, maybe we might all. The point of this is kind of that there are pieces of that car, the failed project that they had, that can still be used in other ways. I think talent, Amanda, is the core of this story. You have kind of AI talent that was used and involved in the creation of the car. You have engineering talent that had looked into robotics and mass production of the car. All of those pieces, without the actual coming to fruition, can be reused for potentially robots. Now, this is interesting because we already know there was another player in the tech space that kind of tried to do this, Amazon, and their potential acquisition of iRobot, which has been squashed by the European Union in January. They dropped the deal saying it wasn't worth the regulatory hassle. But it feels like the consensus here is that if it's not AI, if AI isn't this mass consumption product, this idea of home robots just might be.
I got to say, iRobot, the cleaning product sort of went sky high on the back of some of these stories. Talk to me about Alphabet, because this is a new diversion. This is an FT story. It talks about Alphabet wanting to charge users for search features powered by AI. So this is the infancy of monetization of AI at a democratized level, and that's what's interesting about this.
It is. It also is a very marked difference in strategy from Alphabet. Remember, Alphabet gets most of its revenue from advertising here. They get it. It is free to the consumer. So to monetize a search engine risks, one, cannibalizing their own business, and two, losing some of their existing user base. And that's really why you saw pressure on those shares, that if this is really being taken seriously, could they lose the 1 billion active users they have around the world, not just in their Google search business, but even their YouTube business, for example, not to mention the variety of other products that Alphabet has under their umbrella. The AI piece is interesting, though, because similar to the Amazon story, where pieces of its former projects now help in its future, for Alphabet, there's a question of, is AI big enough for them to really use in their search engine? Is it better used in their cloud computing division? Remember, Alphabet, yes, a big tech company, is still third place when it comes to Microsoft and when it comes to Amazon Web Services.
Okay, Kriti, thank you very much. Kriti Gupta there covering the tech angle as we're waking up here in New York. It's just gone 5:19. Let me just show you what deja vu looks like. Okay, you've got gold slightly coming back from its sort of record high that we pumped through. Just had Alfonso Pecadiello again talking about flashbacks to 2007, rising commodity prices. You've got copper solidly through that 9,000 level. Gold, as I say to you, another record high taken out at 2,300, just coming back. Central banks have been buying gold for 9 months in a row. And silver just retraces from its July 2021 high. But copper is on the up. If you believe in the China rebirth story and growth story there, that is certainly helping the copper market this morning. Right here on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
So over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components, because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team, because we have a very diverse landscape of customers.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York. Here's what you need to know. Powell signals the Fed has time to assess the data before deciding to cut rates.
On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Apple explores personal robotics for its next big bet after Project Car fizzles. And the Disney CEO, Bob Iger, won the proxy war, but now battles unresolved challenges from the struggling movie business to finding his successor. A very good morning. We've had the soothsayer, that is Powell, assure the markets that rate cuts will come and that the recent bumps in the road on inflation are just that. They are bumps in the road. So that angst has been taken out. In terms of flow momentum, some people question, was momentum running out of breath? Will Citi say persistent risk demand in terms of momentum flows? Keep an eye on Meta. We've got Wells Fargo upgrading the stock, 20% upside. Strong first quarter in terms of the numbers. The stock is one of the biggest pre-market risers this morning, up over 1.33%. I want to show you what's happening in the bond market. This is the first 30 minutes of this show. Alfonso Pecadellos, like steepeners. This is the 10-year yield over the past 4 days, 22 basis points at one juncture. We've given some back because of those soothing words and the prices paid. Soothing words from the Fed, from Jay Powell, that rate cuts are coming, and indeed from prices paid being the lowest in 4 years. And so to a certain extent, that takes some of the heat out of this bond market angst that we had seen over the past number of days. I love what BMO Ian Lingham had to say. All the waiting and no seeing. So we need to see some delivery. And again, Alfonso Pecadello suggests that the Fed is living in a 2007 redux. Another Fed governor spoke yesterday, and it was Adriana Kugler. This is what she had to say about borrowing costs.
Even with demand growth cooling, given the backdrop of solid supply, my baseline expectation is that further disinflation can be accomplished without a significant rise in unemployment.
Joining me now is Marvin Barth. Good to see you, Marvin, founder of Thematic Markets. It's been a while, sir. So here we are with Powell, Kugler, assuring us that, well, Powell assuring us the rate cuts are coming and we should not be distracted by bumps in the road. And then we have a 1-2 punch that inflation can be tamed without something systemically going wrong in the employment market. Where do you stand on the taming of inflation, bringing inflation back to heel without a major disruption? Good morning, Marvin.
Good morning, Manus. It's nice to be with you again. Look, I actually stand in both camps, if that sounds strange. I don't think that Chair Powell is correct. I don't think they're going to be cutting, certainly not 3 times this year. If they do cut, it's maybe a maximum of 1 time. Just the economy and inflation are not going to cooperate on that front. The final mile for inflation is going to be difficult. But the economy is booming. It is doing fantastically well. So the hard landing scenario isn't there either. So actually, Governor Kugler's is actually correct. But, you should not pay attention to the Fed's forecast. They've been wrong this entire cycle. Why should you start paying attention to them now? They've been 100% wrong the entire time.
They've been 100% wrong. Therefore, the dots. So I'm going to go with your thesis, Marvin. These are not my subjective opinions. I'm extrapolating your thesis. So they've been 100% wrong all of the time. The dots are completely wrong. The guidance is completely wrong. I mean, are you throwing everything out, Marvin? Because that, I'd have to challenge that a little bit. Come on.
No. Oh, okay. Well, tell me the last time they were right. I mean, they haven't.
To be fair, they got transitory wrong. To be fair, they've been promising that we're going to make the last mile down. Okay, let's contain ourselves. So if they're wrong and they're not cutting, I want to take that into markets. This mini backup that you had in yields this week, does that go much further and extend much higher if there are no rate cuts coming and inflation is, as you say, going to be sticky and the Fed is wrong?
Well, look, I think the underlying problem here is that people have the wrong model for what R-star is. They're still trying to use the Laubach-Williams model and listen to the Fed. The Fed is very dependent on that model. That model has been consistently wrong, and that's why they keep getting it wrong. And markets are using the same model. Most of the economists that you're going to have come on here from any of the big banks are going to use the Laubach-Williams model as their measure of the neutral interest rate. Now, if actually neutral interest rates are sustainably higher, which the fact that the economy is booming amid high real interest rates right now is telling you that indeed the neutral rate is higher. I mean, it's obviously the fact there. And so what's happening is, you're right, exactly as the Fed keeps trying to forecast, oh, we're going to be able to cut. Markets have also, if you look at one-year forward rates, they have been consistently wrong for the past 3 years. They have not come down the way that the markets expected, and I think that's still the case now. It still makes sense to be a payer of one-year rates, to be short 2-year bonds.
What does it mean for this equity market then? Because I've had everybody come on the show and go, you don't need to worry about rate cuts. That's not going to push equities higher. And if I take your thesis, we're booming, unemployment is low, everybody has jobs, we're getting wage cuts. So no rate cuts is not a distraction to the momentum and trajectory of U.S. equity markets.
Yeah, well, let's think about what actually is behind neutral rates. And this actually gets to the fundamental problem with the Laubach-Williams model. The Laubach-Williams model seems to derive, not seems to, it actually does derive the neutral rate from the rate of inflation. That's not where neutral rates come from. Neutral rates come from the marginal product of capital. If we're having a productivity boom that is starting to show up now in the data, that's driving this big CapEx boom that has actually been going on for 10 years now, then what should happen is earnings go up and real interest rates go up. And that's exactly what we've seen. So equities actually are going to do perfectly fine through this.
So are we in, you talk about a productivity shift, are we in the birth of that, Marvin? If we spent 3 months now obsessing about AI, it's coming more alive every day. We talk about it in a different way. So how much productivity improvement do you think that we're going to see? Is it going to continue? And are we at some kind of paradigm shift in productivity, to coin a phrase from another great central banker?
Well, I go back to my American roots, even though I'm here in London. I'm gonna use a baseball analogy, not a cricket analogy. We're in the middle innings, right? So to me, this feels very much like when I was at the Fed back in the 1990s, when people were still debating, are we actually having a productivity miracle? Because it hadn't shown up in the data yet. Now, of course, we saw that it was there, but it took a while for it to show up in the data. That's exactly where we are now. And it's not about AI. The thing that's been driving this has been automation all along. What people have thought was deglobalization that was politically driven was never politically driven. That may have added to it. COVID added to it, of course. What's been driving it is it's actually cheaper to use robots and automation in the U.S. than it is to use an outsourced globalized supply chain. And that's been going on for 10 years. You can see it in the data.
Does that accelerate if we get a change in political complexion in the United States of America? Of course, what I'm referring there to is if there's a shift from Biden to Trump and to a GOP sweep. Does that thesis that you put forward, does that accelerate over the next 4 years, if that is the outcome, Marvin?
I think the bigger accelerant was twofold. It was one, COVID teaching businesses that indeed the costs of disruption from an outsourced globalized supply chain were incredibly high, and that they could do it just as cheaply with robots now. So that was a big one. But also, I know that a lot of Biden fans are really going to be upset about this, and I don't remember who coined the term, but Biden's policies are basically polite Trumpism. So I'm not sure there's a big difference there.
Marvin, what a way to sort of circle off and leave the conversation there. You managed to get baseball in and a bit of politics. Listen, it's great to have you back on the show. Do come and join us. And when you're in New York, feel free to get up early and join Danny and myself. That is Marvin Bath, Thematic Markets, my guest this morning. Investors are divided, as Marvin has been saying, on whether the Fed will cut or how many cuts we will get this year. So let's just take a listen to the CIO of T. Rowe Price and what he had to say.
One of the things that really stands out to me is if you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot. And that would lose credibility, and you would have a really big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC. It sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now in our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
The divergent views on what we should do, what we should expect from the Fed. That was the CIO at T. Rowe Price speaking to the surveillance team. Quick snapshot of what's going on in the rates market. This is the yield curve. We've had Alfonso Peccatiello favoring steepeners. You can see we've had this re-steepening of the curve as the debate rages on whether you will and should have rate cuts this year in 2024. Coming up, film and TV giant Paramount is in exclusive talks with Skydance. The details on the players coming up on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg. Brief from Menace Cranny in New York. Shari Redstone has reached a tentative deal to sell her controlling stake in Paramount to Skydance. The media drama has been developing for months. Kimberly Adams joins me now to talk it through. So we were just chatting in the break there. You said this is a tentative deal. So what is it that she's got an optionality on? Everybody seems to have an interest in Paramount. What's she locked in?
So right now, what this move means is that it's just going to put a pause on conversations with these two companies right now, and it's not going to allow any of the other suitors to get in while they talk. So you've got suitors like media mogul Byron Allen. You've got Warner Brothers also interested. And of course, the big one, Apollo Global Management, really had a stake here. They really were interested. This is going to give Skydance the edge over Apollo. Earlier, they offered to pay about $11 billion for Paramount's movie studio. So I don't think that set well with Paramount. So then they came back just on Sunday and they offered to buy the entire company. So on the DL, it looks like, you know, Paramount was already talking to Skydance. So they already had plans to do this. So by the time Apollo came back and said, wait a minute, we'll do the whole thing, the whole company, they said, well, not now. We got 30 days. We're going to have this talk with Skydance.
The train had already left the station.
The train had already left the station.
Okay, and so we'll see what optionality they get. If I said to you, look, what are the hurdles? I mean, they've had a lot of interest.
Yeah.
Okay, so we can sit here and debate whether TV's still got a future or not. Hopefully it has. But what are the hurdles to getting this deal done?
Well, right now you have the two have already come to terms with this deal. It's not official, but it is tentative. So they've come to terms with this. But Skydance has made it clear that in order to close the deal, that it needs to make sure that it's allowed to merge with the studios. The studios are vital. That's what people want. They want the studios as well. So Skydance has partnered with Paramount, we know, in the past, with movies like Top Gun Maverick. So I feel like, you know, they feel the need for speed. They want this deal to happen right now.
They want it to happen. Best movie ever.
Yes.
There you go. We managed to get it in.
Yeah, it's a great movie.
Let's take a look at that. That takes you back. We were all a bit younger when we watched that. Kimberly, thank you.
You're welcome.
Thank you very much, Kimberly Adams, on the deal flow this morning. Now, we've been covering this story for quite a while. Of course, it's about Disney, the CEO there, Bob Iger, winning the proxy vote over the investor Nelson Peltz. The headaches remain. Reviving the movie business, selecting the firm's next chief executive, Iger's real challenge for the entertainment giant. It begins now. Charlie Wells is with me. Charlie, good to see you. He has some swagger in Iger to win the vote, hasn't he?
Yeah, I mean, look, Iger is known to be the most powerful executive in Hollywood, and this really was a big thorn in his side that sort of gives him some steam going into the turnaround that he really needs to execute at Disney. And man, as you said, you know, this difficult proxy campaign is now over. It was one of the biggest, most expensive. Disney spent $40 million on the campaign. They sent campaign videos to individual investors. There's a lot of retail investors in Disney. They used Donald Duck's uncle in some of these videos. They talked to institutional investors to win it. But as you said, the challenges are here. And a lot of the issues that Nelson Peltz was talking about succession, about some of the content, those are not solved and they still remain.
Now, is Nelson Peltz going to retreat? I mean, he says he's going to continue to watch the performance from afar. So it sounds as if it's sort of slightly less aggressive tactic in the first response. What do you think is the next step for Peltz?
Yeah, I mean, look, this is his second proxy battle with Disney. You know, the last one was just, you know, the year before. And so what we do know is that Nelson Peltz's Tryon Partners controls $3.5 billion of Disney's shares. So they still have a lot of skin in the game. And as, you know, I mentioned, those issues just are not resolved yet, you know, and some of these content issues are difficult. It's really difficult to produce a movie. It's really difficult to produce a hit. And that was one of the issues that they were talking about. And of course, Disney has long had succession issues. Of course, we know that Bob Chapek was really only in the seat for 2 years. Bob Iger is back in his kind of second tour of duty as the CEO. And again, that wasn't solved yesterday, and it really remains to be dealt with.
Look, Iger has taken the streaming business, dragged it kicking and screaming. He's cut a lot of jobs. He's gone for a big capex plan in the parks. You know, where does Disney go from here?
Yeah, I mean, look, it's looking like the fundamentals are pretty strong. You know, in February, in one of their earnings calls, they actually took the rare step of bringing out some profit projections for this year, and profit is expected to be up 20% this year, so that's a positive story that they've got. We know that, you know, they treated the proxy battle like a campaign, and in a lot of ways, they're treating some of their infrastructure investments sort of like the Inflation Reduction Act. They are saying that they're going to put $60 billion into parks, and we know that parks are really important for Disney. They're, you know, 70% of profit for this company, and so trying to make sure that they're making these investments, that they are, you know, evolving for the streaming era. We heard Iger talk about a deal that he's got with some competitors to try to modernize ESPN for the streaming era. These are the things that they're going to need to focus on, but these are the things that are really difficult.
Indeed. Now, I've always got an eye on what's going on in the music industry. Tell me about Kiss. They're selling their catalog to Popeyes for $350 million.
Yeah, look, I mean, it's really interesting, and it kind of speaks to the issue of content and trying to modernize content for the modern era, just like, you know, Disney is struggling with. And Kiss here, you know, for $300 million, they're selling it to a Swedish entertainment group, actually co-founded by one of the members of ABBA. They are the company that's behind the ABBA Voyage here in the UK, and that makes $1 million a week in the UK. So I think Kiss is really trying to think about, you know, what their legacy will be. They sold not just the catalog, but also, you know, imaging rights. And what our reporting has said is they've already gone to the studio to put those bodysuits on that they need to create avatars for these shows. And I think the takeaway here is that content is still valuable. Consumers are still willing to pay for it, but it's about where does the consumer want to enjoy that entertainment? Do they want to do it through terrestrial television, or in the case of this ABBA experience and a potential kind of Kiss experience, do they want to go to some kind of theater and have that 3D kind of avatar experience? And it's sounding like increasingly the answer is yes.
Indeed. Well, of course, we've seen a whole genre of avatars, certainly around the ABBA phenomena. Don't know about the hair and the makeup, though, Charlie. Don't necessarily know that the leotard and the hair and the makeup is necessarily for me. Charlie, thank you very much. Charlie Wells on the Kiss catalog on the auction block. Coming up, we're going to take a look at some of the market-moving events that'll set the agenda for you right here on Bloomberg Beef.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and, you know, any given day it would be the head of a studio, and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
This is Bloomberg Brief. I'm Menace Cranny in New York. A look at what is ahead for you today. More Fed speak, this time from Thomas Barkin, Patrick Harker, Neil Kashkari, and more. We also get a round of jobless claims data and trade data coming through at 8:30 a.m. Eastern. And the Bloomberg editor-in-chief, John Micklethwaite, sits down with Argentina's president. That is at 3 p.m. Eastern. Don't miss that conversation. In terms of other stocks that you should probably keep a roving eye across, it's on Tesla, up 0.75%. Musk says that he's boosting Tesla Pay to stop OpenAI from poaching staff, so a little bit of a bid there. Micron up 0.8%. You've got analysts there seeing limited risk from the quake, so that is sort of got a nice bid to it. And Amazon up 0.5%. We have news flow coming through that they are cutting jobs at their cloud computing division. Of course, the revenue of the cloud computing division was under a lot of pressure. That's state of play on those individual equities. Keep an eye on those. In terms of the rest of the assets, we've got equities bid up, we've got yields rolling over, so a little bit of a complexion for you. Yields coming up. We had been on 22 basis points up until yesterday when Powell spoke, and of course the prices paid coming in lower at a 4-year low. That helped the yields roll over. The dollar's down by 1/8 of 1%. SPOOs are up 1/3 of 1%. Marvin Budd just with us there nice saying the equity market in the US remains unchallenged. Go momentum. That's it for Bloomberg Brief. The surveillance team are up next.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Culture is they call organizations superorganisms. It's a collection of
people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values. Personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a super organism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Is the possibility of more rate cuts. So that would be positive. On the flip side, if you start to get true weakness in services, that challenges this incredible rally that we've seen in the economic activity of this country and this idea that everything can keep going gangbusters for a foreseeable future.
The economic data continues. It's a week full of jobs data. We had job openings coming down just a little bit, not as much as expected. Big upside surprise on the ADP report, which is like the bland appetizer for payrolls on Friday. Later on this morning, jobless claims on deck.
Jobless claims on deck, and then, of course, Friday. Everyone's going to be looking to what does the labor market say in terms of the health of the U.S. economy. John, you made this point yesterday. We got 200,000, I believe, was the estimate for the survey on Monday. It just keeps ticking higher, a little bit north of 200,000. Powell yesterday, when he spoke, really wanted to emphasize this moment they're in, risks to both the upside and the downside, and how he still sees this as a dual mandate.
The B coming up again, the B word, bump. Your favorite word. This is what Chairman Powell said. Is it too soon to say whether the recent readings represent more than just a bump? Too soon to say?
He's saying that basically it is too soon to say, and at the same time, he seemed to want to cut rates and saying that there's plenty of time before June. That seems to be the theme that we keep hearing. Honestly, we're looking right now at a market that's pricing in more than a 60% chance of a June rate cut. So basically, this is a market that's come full circle that still thinks that the Fed will have the opportunity to cut rates. I guess that, just to go back to where we began, what is kind of good for markets when it's kind of bad, right? Like, when is it bad enough to get inflation down, but not bad enough to challenge this incredible rally that we've seen in the underlying economy? That's the needle that we have to thread kind of at this moment, given how high valuations are.
We've got a great guest alongside us around the table this morning to answer some of those questions, so let's get to him in just a moment. Equity futures on the S&P 500 positive by 1/3 of 1%. Yesterday in the commodity market, Brent crude 89.99. Very, very close to 90. Unchanged this morning at 89.35. WTI 85.47. In the bond market, there we are, adding another basis point to a 10-year, Lisa, 435.93.
And where it's come from is really interesting. A number of strategists over the past 48 hours were talking about how 2/3 of all of the gain that we've seen in yields has been real yields. This has been a shift in expectations for how little the Fed can cut rates this year. That is what is affecting equity valuations, and that's the reason why potentially on the margins, bad news economically, on the margins might be somewhat not terrible news for on the margins certain parts of the equity market.
Kinda on the margins, maybe a couple of phrases you'll hear a lot this morning. Coming up through the next 60 minutes, John Stolfus of Oppenheimer as Fed Chair Jay Powell holds the line. Michael Herson of 22V Research as Treasury Secretary Janet Yellen heads to China. And Israeli Economy Minister Nir Barkat ahead of a tense call expected between President Biden and Prime Minister Netanyahu. We begin with our top story. Fed Chair Jay Powell sticking to script as investors shift attention to payrolls tomorrow. John Stolfus of Oppenheimer raising his S&P 500 price target to 5,500, saying this: for us, the big surprise this year has not been so much the resilience of the economy, but rather the substantial capitulation among the bears and the bearish community. John joins us around the table for more. John, good morning to you.
Good morning, John.
Are you saying the start of the year has just been a short squeeze?
Yeah, I think so. Well, in part, it's been a short squeeze, but I think the other thing is business is showing that it's resilient. The jobs market is showing that there's resiliency. The consumer has slowed, but the consumer is still relatively resilient. So we just think if you get sustainability of resilience, that's the new operative phrase. It was an operative word last year of resilience, but now you have to add sustainability of resilience.
We've talked to you about this a few times. Coming into this year, you were bullish. You were constructive on stocks, but that was independent of a view on the Federal Reserve, because you've said all along this Federal Reserve might not cut that much, if at all, in 2024. That view hasn't changed, has it?
It hasn't, and in fact, John, what we think is that when the Fed actually finally gets down to cutting, it may not be cutting because we're in a recession or the Fed fears that we could move into one, but rather it's got the job done. And it might be considering that it has 2% in sight, you know, on the horizon, or that we've actually arrived at it. That I can't quite tell, but we've been big fans of the Fed for years because, you know, I've been in the business for 40 years, and I learned early on. Volcker was head of the Fed, and he was in second term. He'd just begun it when I came into the business. I learned fast, if you don't get attuned to what the Fed is doing, and since Bernanke, the Fed has been so communicative and transparent, it's really very helpful, to say the least.
So if the beginning of the year was a short squeeze, they're out. The bears have been duly humiliated. Now there's a question of how do you get more bullish when everyone seems to be coming to your side? You talk about, you know, don't throw the babies out with the bathwater, and if you see some babies that have been thrown out, go cuddle them and bring them in. Are there really babies being thrown out with the bathwater? Is there bathwater being thrown out? We're not really seeing pullbacks.
Oh, you know, the pullbacks are very, very small. I mean, the other day there was somebody, the market was, the Dow was down 400 points, and people were going like it was plunging. And I said, compared to what? You know, it's ridiculous. And you see the S&P, you'll find it's down 0.1%. People are burying the bull market. I just think that where we are now, it's a process of, it is a transition. Transition has been given a bad meaning, you know, from when the Fed was behind the curve. But transitions can be relatively long, and inflation is an insidious thing. It takes time to get rid of. When it arrives on in an economy, it becomes embedded quickly. And it just takes a while to get it out. It takes the Fed a while, and we think they're working on it. And we think Powell is committed for his legacy. He doesn't want to be remembered as Arthur Burns. He doesn't want to have to be remembered as a Paul Volcker. He just wants to be Jerome Powell, who got it once he got away from being behind the curve. And so far, so good is what we think.
So I'm going to put a theoretical idea to you. What if on Friday we get a huge number? Is that a better risk for the equity markets, or if we got a really weak number that did justify more rate cuts? What would be a better situation as an equity bull?
Well, that's kind of hard to tell. It depends upon what Kool-Aid they're drinking on the trading floors and the trading rooms around the country in that day. There's a capriciousness related to the markets when it comes to data. I mean, you look yesterday when Powell initially had spoken, the market went down, and then it thought about it and said, you know, this isn't so bad. And you get that, and it's so you just have to. It's not so much roll with the punches as you have to have you have to have context. How's that?
Oh, that's perfect.
You know, it's compared to what? It's the old thing. I can't think of the jazz musician who did. I can't remember who it was, but it compared to what was a great tune back 20, 30 years ago. When I was still a young man.
John, let's talk about where the bar's at, which essentially is what Lisa's getting at. The bar's higher now than where it was at the start of the year. And we're thinking about where there is scope for upside surprises, potential for positive surprises. Do you have to look abroad for that? I'm just going through the quarterly gains that we've seen in Japan, up by something like 21%, in Europe up 12%, in the US up 10%. Is there still scope for upside surprises abroad?
Well, we think there most certainly is. There's an appetite for abroad. The problem with abroad is it's for U.S. investors, it's translating your returns. I mean, the Nikkei is up, what, 20%, but if you compare it, you do it in dollars, it's only up about 11% or 10%. So, and when the U.S. investors jump in, that's when all of a sudden you ignite the global markets, and that's been missing for almost a decade in the international markets. And it's a structural problem. They just don't have technology, and technology is your driver at this point in a very meaningful way.
So you want to keep meaningful exposure to international markets like EM. Where exactly in EM?
Meaningful exposure would mean, with related to IFA, you're going to want to be hedged in the currency. You want to hedge your equity bets with some kind of a hedge. If you use an ETF, there are a bunch of, there's one or two providers that offer a hedge to the currency. With IFA, with Japan. You know, somebody needs to come up with one for Mexico. Would probably be a good idea in an election year. It'd be helpful. But related to the international, the big problem for the international markets is structural. And the structure is, when you look at Europe, Europe is such a different business cultures that all meet across the board somewhere when it's related to interest rates or social programs or whatever it is. It's highly complex. And here we don't have that. We have our own complexity, but that's another story for another moment. But so when we look at it, you need exposure, but your overweight still is the U.S., and you got plenty of international exposure with the S&P 500.
For someone who's incredibly sanguine about the idea of higher rates just over a longer period of time, someone with plenty of context going forward based on your decades of experience in the market, at what point do real yields start to really concern you, given the fact that we're back north of 2%, we're at the highs of the year, and this has been really the crux of where we've seen the yield lift that we've seen so far this year?
Yeah, well, I think the big thing with this is the end of free money we see as a good thing. We were in free money when the Fed had that 0 to 0.25 band. Now we're at, 5.25 to 5.5 on the benchmark rate, the band. It equates to a 10-year right this morning about 4.3%. I'd say that, probably where it really would get probably problematic would be at 6%, but we hit near 5, and it upset the market. It got indigestion, but then people kind of looked around and they said 5% on a 10-year bond. They went in and they bought them, and we haven't seen that since.
You're saying that if 10-year Treasury yields climbed past 5%, 5.5%, as long as they didn't hit 6, the market would be fine?
I think it really could be, yeah. And I think it would be, there'd be indigestion, mind you, but I think the reality is it's today, for years, for almost 15 years, for most of that period, we had bond issuers were getting free money most of the time from the financial crisis, the pandemic, post-pandemic, all this different stuff. And now bond issuers have to pay for the privilege of borrowing money, which if you lend money, whether you're depositing a CD or you're buying a treasury or a corporate, what have you, or a municipal, it's nice to get something in return in terms of yield other than your principal back at the end of the period if everything works out. And that creates a healthy market, we believe, in terms of all types of investors when it comes to, I think the biggest complaint about the rate regime of this Federal Reserve comes from the highly leveraged players. And with rightfully so, they made billions and trillions in aggregate probably over the last 15 years placing bets that today would cost them much more if those bets went wrong. And even if they go right, it hurts them. I mean, it was on Bloomberg News a few months ago. There were 2 really renowned short sellers who closed operations. I'm not going to mention their names, but they were kind enough to admit it, that they were getting killed. And this is a healthy thing. I mean, my first mortgage was 10%. My boss's first mortgage was 16%. I think his boss's was 22%. When I speak to groups of people, I've run into people with 18%. We all lived, and we even made money in real estate.
And your house was 3 times salary, and it's like 10 times now.
Well,
different
that
times,
is,
John.
I knew you
John,
were
you're very right about that.
Because you're going to wind me up, John. It drives me nuts.
But
I knew you were heading there.
That's liable to be changed when the Fed begins cutting at some point, when it arrives at its target. And then I think, if anything, residential real estate could probably get a little bit of indigestion because there'd be so much put on the market.
You think rate cuts lead to more supply and prices actually drop?
Yeah. I do, because it's when you get rate cuts, all of a sudden people are going to find, wow, I can get something if they can get 4.5 maybe. But to think that you're going back to there were mortgages. I remember there were people getting mortgages of like 1.78%. Running down the street just screaming, look what I got.
They're still running down the street.
And they still aren't for having it. And that's why you've got an illiquid residential real estate market.
That's what we've got.
Yeah, but the other thing is, with all of this, is one of the elements that keeps inflation stickier is it takes longer for competition to reemerge when you come out of inflation. Because when you go into inflation, those who get hit by the input costs hesitate to pass it on to their customers. Then, once the press announces that it's happening and the Fed says there's inflation, everybody suddenly accepts higher prices initially. Yeah. And then when the Fed starts having success, what happens is everybody's reluctant to start competing, and they just kind of match each other's prices. It's not collusion or anything. They just see the environment. And then somebody says, you know what? What I lose in per unit price, I just might make back in volume It happened in the 60s. It happened later on in the 80s and the 90s.
Yeah.
And it's that competition, especially with technology where it is today, I think is around the corner, but not quite imminent.
We could do this all morning with you. It's so nice to have you next to us, John. It's good to see you.
Thanks.
John Stolfus there of Oppenheimer. Price target 5,500, year-end on the S&P 500. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Heckes. Hey, Yahira.
Hi, John. Carlyle Group CEO Harvey Schwartz was awarded a $187 million pay package in his first year running the private equity firm. Most of that was $100 million of stock, which vests over several years and is based on how well the shares perform and how long he stays at the company. He receives a cash bonus of $6 million, which was double the size of his target. Paramount Global is getting closer to a deal to merge with David Ellison's Skydance Media. Sherry Redstone, Paramount's controlling shareholder, has reached a tentative agreement to sell her stake, according to people familiar with the talks. Shares of Paramount have been under pressure for years, reflecting the company's loss of TV viewers and costly efforts to develop a streaming service. The media company had a market value of nearly $9.2 billion at the close of trading yesterday. Rock band Kiss is selling its song catalog as well as its name, image, and likeness to Sweden's Pop House Entertainment Group. Sources say Pop House is paying more than $300 million for the deal. The company plans to make a biopic about the group as well as a live music show featuring avatars of Kiss's legendary band members. Pop House has already made a live show featuring avatars of pop group ABBA. That show makes more than $1 million a week in London. That's your Bloomberg Brief. John?
Pause. 10% mortgage, 200K apartment, 2-bed with a roof garden in Manhattan. Let's never talk about mortgages together again.
Actually, it was 210.
210.
But remember, the money was worth a lot more.
2 beds with a roof garden.
But the dollar's been devalued many times since then.
We're talking like $5 million in New York for that now. Up next, Treasury Secretary Janet Yellen taking on China.
We've agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Can you imagine a two-bed with a roof garden for $210,000 in Manhattan?
Yeah, like in 1903.
Like,
I've been Zillowing. It doesn't exist.
And then they talk about 10%, 15% mortgages back in my day. I mean, come on.
It's a different time.
It's completely, that is not apples to apples at all. Equity futures on the S&P, positive by a third of 1%. Bond yields a little bit higher by a single basis point. The 10-year, 435.93. Under surveillance this morning, Treasury Secretary Janet Yellen taking on China.
We have agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field. We went for too long with too little communication, and misunderstandings developed.
Here's the latest this morning. Janet Yellen landing in China just moments ago, a meeting with top officials as concerns grow globally over the country's growing subsidies in manufacturing. The 5-day trip marking Yellen's second visit in 9 months. Michael Herson of 22V Research writing this: the trade and investment relationship remains under strain, particularly on tech-related issues. The intense geopolitical rivalry and domestic politics in each country limit the room for active cooperation. Michael, I'm pleased to say, is with us now for more. Michael, let's get straight into it. What is at the top of the agenda for Janet Yellen on this trip?
Well, I think for the U.S. side, it's definitely this issue of excess capacity, or really, China's very aggressive focus on promoting advanced manufacturing, particularly in some of the same strategic sectors that the Biden administration is focused on. So electric vehicles, solar energy, that is top of the U.S. agenda. And it's a trade issue, but it's also a macro issue for global growth. And I think that's one reason why it's Janet Yellen delivering this message and not necessarily U.S. trade officials. That's definitely top of the priority list for the U.S.
Michael, when I was reading and listening to what Janet Yellen had to say, I kept thinking, what's the distinction and how big is the distinction between decoupling and enforcing a level playing field?
I think for Treasury Secretary Yellen, there is a big distinction in the sense that I honestly think, as a trained economist, that she believes that trade is good, and that she wants to deliver a message that the U.S. does not seek to decouple. Now, that's kind of a controversial view in the U.S., and I think to some extent even within the Biden administration. But generally speaking, I think she is trying to say we want to have trade, but we need to address what on the U.S. side is considered these distortions coming from China's manufacturing sector.
A lot of the focus has been on green energy and the supplies that are needed to really push forward the entire platform by the Biden administration. How much are the Biden administration's hands tied in a way? Because they are looking to shift toward certain types of technologies that require metals and technologies that are dominated by China.
It's a very difficult balancing act. And I think, it somewhat depends on the sector. It's something like solar. China's cost advantages are just so extreme at this point that, it's very difficult to meaningfully, decouple from China or take really aggressive actions in the solar sector. And something like electric vehicles, it's a bit more nuanced, but I think that is the balance that they have to face. And again, it's one reason why Janet Yellen is out there. Instead of just slapping additional tariffs on these items, really the solution for both sides should be to try to work on some kind of accommodation to address the concerns on each side.
She alluded to tariffs, though, yesterday. She said, I wouldn't want to rule out other possible ways in which we would protect them, talking about clean energy. Where does the U.S. stand right now? Where is that tariff review?
That's a good question. There is a tariff review that's been underway, and we've heard numerous times that it would be out, for example, at the end of last year. I think, frankly, it's unlikely that we're going to see any really aggressive moves, certainly to lower tariffs, and it is possible that we're going to see moves to increase some of those tariffs. Perhaps we would lower them on some of the consumer items that aren't strategic coming from China. But I think tariffs are going to remain part of the toolkit, especially on an area like electric vehicles, when you see this export surge that's showing up in Europe, but not showing up in the U.S. And I think trade officials in the U.S. are going to want to keep it that way.
That's the one we're looking for. Michael, thank you, sir. Michael Herson there of 22V Research. We've got Yellen in China. This from Politico this morning. Blinken making a return to China shortly. Defense Secretary Lloyd Austin having a call with his Chinese counterpart soon. This is all kind of building up.
It is, and this started in November when President Biden met with Xi Jinping in California. They agreed that they would ramp up and try to make sure that they have communication between both countries continuing. Remember, it's not just for the U.S. that wants to keep a lid on this relationship, especially in election year, but Xi Jinping, you know, these officials are coming after he met with executives. He wants to make sure the economy is open for business.
They've been reviewing these tariffs now for ages. I remember they were reviewing the tariffs with Brian Deese at the National Economic Council. That was a few years ago, just sort of on the table, left there.
When we were in Davos, one of the most interesting things is what is the daylight between the Trump and the Biden international policy? Not a lot, because it hasn't changed.
The tariffs were terrible at the time. The tariffs are still there, right?
And they're likely to only get more stringent, and that's what we heard from Michael Herson.
Equities right now on the S&P 500, positive 1/3%. Up next on this program, the Israeli economy minister, Nir Barkat. That conversation up next from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Now, weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Equity futures on the S&P 500 positive here by 1/3%. The equity market attempting to bounce. Some very muted marginal gains in yesterday's session. Equity futures right now up 0.4% on the Nasdaq. The Russell to small caps doing okay. Big reversal in this bond market yesterday. What a trip we've been on over the last week. 420 on a 10-year. To win Q1, kicking off Q2, getting to 440 really quickly. Then the reversal started with the ISM services print yesterday, Lisa, followed up by Chairman Powell. Yields lower off the back of those 2 points.
I love what John Stolfus was saying, that basically on first glance, people said, oh no, maybe this is a different Fed Chair, Jay Powell. And then they analyzed his comments and realized, no, the recent data didn't, quote, materially change the overall picture, and that on inflation, quote, it is too soon to say whether the recent readings represent more than just a bump. This is still a chair that wants to cut. Let's go to the races.
That's the bond market. Let's get to the races and switch out the board and turn to commodities. Just briefly, I want to talk about this in commodities. Crude right now, very, very close to 90. 89.99 in yesterday's session, Lisa, then backing away. I think you're right to bring up, how should we interpret the move in bonds, fixed income, yields getting close to 440, and the move that we're seeing in crude, getting closer and closer to 90? What does that mean for stocks?
Does that mean that there's a lot of demand and that that's a really good thing for growth? Or does that mean that potentially inflationary pressures are coming back in a way that could be punitive to the consumer buying power? And also just in general to a Federal Reserve that has to keep rates higher. This is the reason why maybe we saw some confused stock action yesterday. People couldn't figure out good news, bad news, good news, a little bit of both. I don't know, just go on.
In terms of inflationary concerns, the ISM chair came out and said to reporters on this call, there is concern in businesses about fuel prices going up. And what does that mean for input costs?
This big move we've seen in precious metals as well. Gold, another all-time high in the last 24 hours, just backing away a little bit. We're down about 1/3% on gold. Silver prices, that's been quite a squeeze over the last week. Silver a little bit softer on the session. We're down by 0.6%. Under surveillance this morning, Fed Chair Jay Powell staying on target, saying he's waiting for more data, but expecting it will lead to rate cuts this year. Powell also commenting on the labor supply ahead of payrolls tomorrow, saying, quote, the Fed is not an immigration policy maker, but adding extra workers have helped a tight labor market, and the economy has been short labor and probably still is, raising very controversial questions about this labor market, Lisa. The heat that's come out of it, how responsible they are for it, and how responsible just a very leaky southern border is for what we've seen.
We've seen this being discussed by the likes of Morgan Stanley, Goldman Sachs, many other economists saying that essentially a lot of the immigration has been the reason why we have seen employment tick up so significantly and why inflation hasn't gone higher and why wages are not climbing at a faster pace. This is going to be an ongoing question. The fact that he has to address it puts him in an awkward situation where he seems like he has to be non-political. And I think that is really going to be the very kind of knife edge that he has to walk.
Let's turn to our next story. The latest on Apple looking for the next big device after scrapping plans to enter the electric vehicle market. Bloomberg star reporter Mark Gurman reporting engineers are exploring a possible mobile robot. Listen to this, which would follow people around their homes. The company is also working on a tabletop home device with a moving display. They continue to look for new sources of revenue as it may take years and years for mixed reality headsets to become a major moneymaker. Do you want to be followed around the home with a robot?
I saw this story and I was like, I can't imagine a Pharaoh bot just following around his house while he's cleaning up and reading over his shoulder. It just seems...
If they do the cleaning for me, I'm on board. Is that what they're going to do?
They have a robo-cleaner.
There are a couple of things. First of all, I pictured someone going around saying, do you actually want to do that? Really? Is that really a good decision, Lisa? I can imagine a very neurotic robot following me around. I do think, though, there is this thing about companionship, especially for older people, and that's been a one source of robotic technologies, one that I think is really interesting because of the loneliness crisis. Not to take it too serious, but I'm just trying to think about ways that it actually could be deployed in a really useful way.
Let's get to a much more serious story. Let's turn to the latest. President Biden expected to speak to Israeli Prime Minister Benjamin Netanyahu by phone later today, according to U.S. officials. The conversation coming after Biden condemned deadly strikes on aid workers in Gaza this week. Domestically, Netanyahu is facing another challenge. Political rival and war cabinet member Benny Gantz is calling for early elections in September. I'm pleased to say that Nir Barkat, Israel's Minister of Economy and Industry, joins us around the table. Minister, good morning to you, sir.
Good morning.
Really important subject. Let's get to a couple of issues. Number one, some of the commentary from the President of the United States. I'll share some of the language that he's used regarding Israel's actions recently. Israel has not done enough to protect aid workers. He goes on to say, Israel has not done enough to protect civilians. We heard from the President of the United States recently that there are other ways to get to deal with the trauma caused by Hamas in early October. Has he shared any alternatives with the Israeli government?
Well, first of all, I want to share condolences with the aid workers that were killed. It's very unfortunate. I don't know if people know that over 30 Israeli soldiers were killed from friendly fire. And 3 of the hostages that escaped Hamas were killed by Israeli troops. So there is, unfortunately, sometimes friendly fire, people get killed. This is a cost of war. We have to realize, though, that the people that intentionally kill people are those Hamas jihadists that October 7, they entered Israel, killed, raped women. I have a picture here, with your permission, of some of the girls that were kidnapped. You see their picture before and after in captivity. Half a year, they're sitting there underneath the ground, raped. We've heard that some of them were raped for the last half year. This is crazy. It's just crazy that these Hamas people and their jihadi strategy is to kill and wipe out all Israelis. This is what we have to understand. This is what we're dealing with, and we cannot leave them the way they are. Similar to the way that Nazis were eliminated in the Second World War, we cannot leave 1/4 of the Nazis in Rafah. We have to make sure that we eliminate them off the face of the earth. And that is the challenge we all have. And we are all united, all of Israelis are united in completing that war and eliminating Hamas off the face of the earth.
Well, let's talk about that challenge, Minister, and we've certainly talked about the tragedy that evolved in early October and the tragic events that have evolved in the months as well that have gone by, with the civilian death toll in Gaza continuing to build. I'll repeat the statement from the President. He said there are other ways to deal with the trauma caused by Hamas. They were meant to share alternatives with the Israeli government. Have they done so?
Well, I don't remember how we dealt with Nazi Germany. I remember that at Dresden, it was totally different. And in all wars, including American wars in Iraq and other places, eliminating ISIS, you have hundreds of thousands of people killed.
Connection lost.
In Syria, over 500,000 civilians were killed, and over 5 million fled away. And so when you look at the way we work, we have no quarrel with the civilians, but we will finish the job eliminating Hamas off the face of the earth.
Well, but there's a real question around who's going to lead the effort to do so. You know, Opposition Leader Benny Gantz, who's part of the War Cabinet, came out and said that he does think that elections should be held early this September instead of 2026 because Benjamin Netanyahu has lost a lot of support among a lot of the rank and file in Israel. Do you think that's a good idea? Is that sort of what's needed to gain legitimacy?
Thank God we're a democracy, and we will stay a democracy. And people have their own opinions on when and why, but we're all united, including Benny Gantz, that we have to finish Hamas. And this is the focus of what we're discussing. I want to share another point with you, which is very, very important, okay? Who's funding Hamas and Hezbollah and ISIS? There's Iran on one side, and Qatar are funding jihad all over the world. And Qatar, many people don't know this, but they're like a wolf in sheep's clothes. They are, the heads of Hamas are at their place in Qatar, and they are funding billions, trillions of dollars, funding terror all over the world, and they're behind this, and we must wake up and understand that it's not just a challenge of Hamas and Hezbollah against Israel, it's against the whole world.
Are you saying then that as long as Qatar acts as a mediator to peace talks or some sort of temporary ceasefire, that it's not going to happen because you don't trust them?
I don't trust them. I trust the Egyptians. The Egyptians have peace agreement with Israel. But Qatar is giving safe haven to Hamas leaders, funding trillions of dollars, buying their ideology in the United States, buying their way in all over the world. They're a wolf in sheep's clothes, and we have to realize that them, together with Iran, are a big threat, not just to Israel, but the alignment with the Emirates, with Saudis, and the moderate Arab states. They're a big threat to the peace in the world.
Minister, going back to Lisa's first point, though, Benny Gantz is calling for fresh elections. There is a growing threat within the Israeli population that they do not want to see Netanyahu leading this government. You're saying that Qatar is the big problem. Well, for years, Netanyahu tolerated millions of dollars going from Qatar to Gaza. So, to her point, does Netanyahu need to step aside? Should there be early elections?
For example, when you talk about Qatar, this is one of the things we've learned October 7. There's no gray anymore. The world has to realize, are you the good guys or you're evil?
But was it a mistake to allow Qatar then, with the Israeli position?
Yeah, I think so. I think that Qatar fooled Israel as well in their jihadi approach. They're really nice guys. They buy their way in, but they're evil, and they're funding evil, and they're a source of problems and trouble to the whole world. And we have to realize that. And certainly, I think that October 7 is a wake-up call. We've made, if you look in retrospect, we thought we could get away with a small army. We thought that the jihadists will never do what they've done. There's lots of things to learn from what happened in October 7. And one of them is the threat that Qatar poses to the world to buy therein and influence the world towards jihad and against, people get mixed up. Who's evil here?
So if you think Egypt should fill that gap,
yes.
Do you think Egypt should also come in and potentially act as a peacekeeping troops, supply them to Gaza? Because we know that Arab countries are not willing to do that until Israel says that they have a plan for a two-state solution.
You know, the Abraham Accord demonstrated what Israel wants. We want peace with moderate Arab people that seek peace, like the Emirates, like the Saudis. We have peace with Jordan for 25 years and over 40 years with Egypt, okay? On the other hand, you have jihadists that don't want to live side by side to Israel. They want to eliminate us off the map. They're against Jews, they're against the jihadi approach, Sharia law. They want to change the world to become only Muslim. And what you're seeing in Israel, what you saw on October 7, if we don't win, is going to happen all over the world. And the moderate Arab states are aligned with the United States and with Israel against evil. This is what we have to remember, and Qatar is on the wrong side of this alignment.
Minister, I'd like to get to some specifics, if we can, on Rafah. Getting civilians out of Rafah, how long is that going to take?
I don't know. I'm not sure that the media is the best place to share Israel's plans. Okay? We don't want to give them to our enemy. But one thing is for sure. The war will not be over until we eradicate all of Hamas. And they're sitting in Rafah, 1/4 of Hamas. We're not going to leave them the way they are. At the end of this war, the world will understand that we will fight evil until they surrender. There's no other choice. And after the war, we would like to see friendly people manage and help
As you understand, the world is trying to understand at what cost that will come with
minimal cost that we can. We have no quarrel with the civilians. We'll do our best.
And are you willing to wait? You're willing to wait a number of weeks to ensure that happens?
The wait is not going to help us. The challenge that we have to complete and finish the war. There's consensus in Israel. We have to complete and find those 134 hostages that are right now, in the tunnels for half a year, being raped, what they're going through. You know, I met the families of the hostages. They can't sleep at night. They can't. Imagine if your family is there and you know that they're being tortured and raped on a daily basis. We in Israel understand that. Time is not on our side. And we have to finish the job, get them as fast as we can, and move on with life.
Minister, we appreciate your time this morning.
Thanks
for
very
being
much.
with us. The Israeli Minister of the Economy, Nir Barkat. I want to get you an update on stories elsewhere. Let's get to the Bloomberg Brief. Here is Yahara Hakez. Hey, Yahara.
Hi, John. More tech layoffs, this time at Amazon's cloud division. Amazon Web Services is cutting hundreds of jobs that will affect sales and marketing employees, plus the team developing the technology used at its physical stores. It comes after sales growth at AWS slowed to a record low last year as corporate customers cut back on spending. Disney shareholders shot down activist investor Nelson Peltz's effort to win seats on the company's board. Investors voted to re-elect all 12 of the company-backed board members, including CEO Bob Iger, this capping the most expensive corporate proxy fights in history. Peltz Trian Fund Management holds a more than $3.5 billion stake in Disney. It has been trying to get seats on the board to address lagging shareholder returns and what it sees as inadequate corporate governance. Tesla CEO Elon Musk says he's boosting pay for AI engineers as the company deals with a talent war. Musk posting on X that OpenAI has been, quote, aggressively recruiting Tesla engineers with massive compensation offers and have unfortunately been successful in a few cases. Musk going on to say the talent war for AI engineers is the, quote, craziest he's ever seen. The tech billionaire is pursuing AI projects through Tesla and his xAI startup. That's your Bloomberg Brief. John?
Yahaira, thank you. Up next on the program, Chair Powell's wait-and-see approach.
We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
That conversation up next, live from New York City. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Equity futures on the S&P 500 positive here by 0.33%. A small bounce in yesterday's session. Yields higher by a single basis point. 436.13 on a US 10-year. Under surveillance this morning, Chair Powell's wait-and-see approach.
These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2%. On a sometimes bumpy path. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%.
Here's the latest this morning. Fed Chair Jay Powell signaling patience as the central bank awaits more data. Jobless claims due at 8:30 Eastern Time, setting the stage for tomorrow's main event, the payrolls report. Jennifer Lee of BMO Capital Markets writing, quote, the jobs report will hold the most sway, particularly as the labour market looks to be gaining momentum once again. BMO expects another solid pace of hiring, looking for payrolls to rise 225,000. The median estimate in Bloomberg survey calling for a slightly lower print of 213. Jennifer Lee joins us now for more. Jennifer, let's just get into the labour market data on Friday. Are you expecting that to come with hotter inflation or not? Hotter wage growth?
So good morning, and thank you very much for having me on. And I think that's probably going to be the most critical
piece of data that we're going to be looking for at that report is what happens with the average hourly wages, especially since what we saw last Friday with the wages and salaries component of the personal income and spending report that was up 0.8%, which was a bit of a shocker to yours truly. But so we'll see how if that pans out in the earnings numbers in the jobs report. But obviously, if we're looking for something with a bit of a hotter number, then that's going to put more Fed doubt into play.
Jennifer, what do you put more weight on? That 10% figure for job switchers in terms of job gains in the ADP report, or ISM services coming in weaker than expected with the idea of prices paid falling to the lowest since March 2020? Which is the better read on the tone we should take from the economic data?
I'm going to say the ISM services numbers. I mean, we all know that when you leave a job for another one, you generally get higher pay. So so that sort of plays into it. And plus, the JOLTS data are a bit lagged. I think the services ISM figure was a little more interesting. But overall, again, we still have some inflationary pressures brewing out there. Of course, most recently with potential supply issues, given the Baltimore bridge collapse, and of course with the Taiwan earthquake. So this is all, and then of course we've got whatever's happening, all the wars that's happening in the Middle East, and of course in Haiti. So all of this is playing up to some potential supply pressures, again, building up a little bit at least, maybe not what we saw back in 2020, but again, just throwing more doubt into when the Fed will actually move and how often they're going to move.
Jennifer, we're going to hear today from the Fed's Harker Barkin, Goolsbee, Mester, Kashkari, Alberto Musalem, and Fed Governor Adriana Kugler. What are you hoping to hear from these folks?
If in my perfect world, it'd be a lot more clarity, but I think they're just going to preach patience again, as Fed Chair Powell did last week. And I don't think he's changed his tune that much. Perhaps the more interesting ones that we've already heard from was Bostic saying he still sees only one more rate cut, and that's not coming until the fourth quarter. So I was a bit relieved when I heard Fed Chair Powell say yesterday that that they will probably find it appropriate to cut rates sometime this year. And my first thing I said to everybody was, well, at least he said this year. He gave us some sort of a time frame. So I don't think we're going to hear too much different opinions from all the different members that you just rhymed off, and everyone's probably going to preach patience and the need for greater confidence.
Jennifer, we get jobs on Friday. We get CPI next week. There's going to be 3 CPI prints before that June meeting. What do you weigh as more important right now in the data you're monitoring to forecast when you think the Fed is going to come in for that first cut?
I think it's all going to be coming down to inflation. Obviously, the totality of the data are very important, but I think at the end of the day, it's all going to be coming down to inflation, the core measures, the services measures, and especially from the CPI deflator, the core PCE deflator as well, which is what the Fed is most watching. But I think overall, if it shows, that what we're expecting is that, inflation is going to be coming down at a slow, steady pace, as long as it's heading in that right direction. I think that will give the Fed enough comfort to move what we believe is going to be in July. But of course, everything is going to depend on the data. Nothing is going to be depending on the calendar.
Well, if inflation is something you're really keen on looking at, how concerned about this uptick we see in commodity prices and what that means for producer prices?
So that, is obviously going to be some upward pressure, but, it depends on how much staying power it's going to have. And we know that there's so much volatility in the commodities market. So again, it's going to be depending on how much it will stick, how much it will stay up there for. But we know that it's not going to be a straight line down. It's going to be a bumpy path along the way, which is, I think, another descriptive word that the Fed chair used recently. So again, as long as the direction is right, we know that there are going to be ups and downs. He's not getting too excited about the January, February strong CPI numbers, just like he didn't get too excited last year with the more moderate inflation numbers. But again, we need to see a few more months of data before we can become much more confident in this trend.
What do you think it would take, Jennifer, for him to stop calling them bumps in the road?
We're probably going to see steadier inflation or lower inflation, I guess I should say, in almost all the different indicators. And again, with all these different factors that are kicking in, it's not going to help. It's not going to make his job any much easier at all. But as long as the trend is there, I think that's when he's going to stop calling it bumps along the way.
Jennifer Lee of BMO Capital Markets. Jennifer, thank you. Appreciate it. Going into a big data point tomorrow morning. Payrolls Friday just around the corner. 213 the estimate. Jobless claims a little bit later this morning. 214 the estimate for that. 210, Lisa, the previous number.
I'm still struck by that ADP job switcher number. I mean, honestly, people then question how much that's actually going to be a significant thing. But if you look at a 10% wage gain for people who decide to change jobs, this is probably the higher paid component. And it raises this question about the labor shortages and where they're shifting now that you're seeing certain pockets getting filled with people coming in, immigrating into the country, and other areas not so much.
I thought you were going to say it raises questions about us all changing jobs. I thought that's the direction of travel.
That's where your mind's at?
No, I just thought, no, I thought that was the direction of travel there, just listening to what you had to say. 10% bumps.
Was saying that he didn't think there'd be a lot in terms of quits rate and the jolts, only because he says, you know, these middle-aged people, they just realize, stick with my job. I don't need to change anymore. That's kind of over. I'm over my midlife crisis.
Did we just pour in freezing cold water over absolutely everything? Is that what we're doing?
No, no, I'm saying that
I just
maybe
think
that's
every economist that comes out at the moment is just pouring freezing cold water over every single data point that just doesn't align with the Federal Reserve's thinking.
In terms of its accuracy and ability to actually have any predictive power.
They're bumps in the road.
They're bumps in the road. And what will it take for them not to be bumps in the road? Nah, they're not going to not be bumps in the road. Basically, people are saying things are going to cool. This is really the key question. And you asked a great question, Anne-Marie, about the idea of commodities. How does that play into it if it's not coming necessarily just from supply shocks, but this is also coming from just so much demand and that recovery that's coming on globally?
Since the start of the year, I've heard exactly the same thing. Wait 3 months, right? Wait 3 months.
Which is
and now we're waiting for another 3 months.
Which is the reason why the payrolls number is interesting to me, because we've waited 3 months and the number has gone up from where we had expected. The rolling average is higher. Now we're looking at wages. Now we're looking at the potential for a new source of labor coming into the market. The goalposts are shifting. And this is really going to be interesting to me. How much do the goalposts shift if we get another hot number from some of the Fed officials who speak?
Jobless claims up next, 8:30 Eastern Time. Up next on this program, the second hour of Bloomberg Surveillance. The lineup looks like this. Jean Bavin of BlackRock, Isaac Boltansky of BTIG, Javier Bless of Bloomberg Opinion, and Terry Wiseman of Macquarie. If we can bring up the market board, I'll give you a snapshot of things right now this morning. Equity futures on the S&P 500 positive by 1/3 of 1%. Yields a little bit higher once again, up by a single basis point, 435.93. Quite a ride in yesterday's session. Yields lower off the back of a softer than expected ISM services print. And let's call it a dovish Chairman Powell, I guess, if you want to. Yields backing away from the highs of the session. In the commodity market, Brent crude very close, very, very close to 90 in yesterday's session. 89.99, the high of the session. From New York City this morning. Good morning.
Of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well, because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.